Hey everyone, welcome along. Thank you very much for turning up for the macro session of this 2025 edition. Thank you very much for your very kind messages on social media. I really, really appreciate it. Thank you very much. Just a couple of things, just to clarify one or two things. I have seen your questions in advance. The chat, if you want to waste your time on the chat and do silly things, it's up to you guys. That's your choice. If I were you, honestly, I would just take advantage of this and lock in, make as many notes as you can, watch it back, revise off it. Again, just to clarify, I am not here to try and predict what will come up in your paper. What I am here to do is to equip you with the skills required to give you the best chance possible of getting an A star. Yeah? So lock in. Let's go. There's going to be a lot that I need to cover in this session. Those of you that are on TikTok, I highly advise that you basically switch over to YouTube, because on YouTube, I'll be able to draw my diagram and you'll be able to follow on there. Yeah? Okay, let's begin. I will try, by the way, so one more thing actually before we start. So one or two of you emailed me saying that, oh, can you try and not repeat topics that you have done in previous Q&As? I can't even remember what I've done in previous Q&As. I love the fact that you guys have watched the previous Q&As. Thank you very much for that. There will invariably be overlap. There will invariably be things that I have done that I will do again, because in the end, my priority is to ensure that you guys are as well equipped as possible to get an A star in the exam on Monday. All right, let's get going. The first thing I want to deal with is a topic which many of you asked about, which is terms of trade. Let's deal with it. So terms of trade is commonly misunderstood because you're programmed to kind of think along the lines of quantity. So you think in terms of exports, imports, and whether you sell more or buy more from the world. And that is not what really terms of trade is about. What terms of trade is about is the monetary value of your exports relative to the monetary value of your imports. That is it. So let's start really basic. And then in a second, I will show you guys an example of a 5-mark question that they have asked in Edexcel. And from there, we'll be able to hopefully really easily answer any question on terms of trade. So let's begin. Terms of trade, if I write it out as a formula, is the price index of exports divided by the price index of imports, and I times it by 100. Okay. Before I actually show you guys a question, I want to make up a question just to see if you guys understand what terms of trade really is. So let's say hypothetically, we were dealing with the UK, and then you were given the context that there is high levels of inflation in the UK. Would that improve or worsen the UK's terms of trade? Well, let's figure it out. Now, the common misconception is people go, oh, inflation's high, therefore you're less price competitive, and exports go down, imports go up. Although that is correct in terms of the current account, terms of trade is not concerned about whether you're exporting more or less. It is purely the monetary value of what you are selling to the world versus what you're buying from the world. And I will prove this in a second. But what happens is this, on my formula over here, so I've got X at the top and M at the bottom, yeah? Would you guys agree that if there's inflation in the UK, that means that what we're selling to the world, our exports are now more expensive? Now, I'm not concerned about whether we buy more, we sell more or less, but the top of the fraction is going up. And therefore, if the top of the fraction is going up, whilst imports, we haven't told anything about imports, is staying as it is, the overall number is going up. I know that might sound counterintuitive, but basically what it is that the terms of trade for the UK improve when there is inflation because your exports become more expensive. In terms of just made up numbers, yeah, let's just kind of do it in this way. Imagine I said to you that what we sell to the world is worth £1, and what we buy from the world is also worth £1. So 1 over 1, I can times it by 100, figure it times 100 for now, is obviously just equal to 1. All right. If there's inflation in the UK, what does that mean? Well, what it means is that things in the UK are now more expensive. So let's say that British goods become worth £2. If imports stay at the same value, then your terms of trade have improved, because for every one sale that you make to the world, it now allows you to be able to buy more from the world. Right, just park that thought in your mind for now. I want to basically do two things. One is I want to deal with the 5-marker from June 2018, paper 3. And the second is to then divert that into talking about economic development and why terms of trade matter, especially for developing countries. So let's unshare over here and let's dive into a past paper together. Right. Paper 3, June 2018, question 2A. Let's do it. Where is it? It is about Indonesia. Okay, so let's delve into it together. All right, sorry, bear with me while it loads. Okay, so question 2A about Indonesia has the following question. It says, Using the data in figure 4 and other information provided, explain the likely change to Indonesia's terms of trade since 2011. Okay, the first thing that you're going to do is you're going to get your knowledge mark simply by telling me what the formula is for terms of trade, which we know. Price index of exports, divided by the price index of imports, divided by 100. All right, let's have a look at figure 4 together very quickly. So in figure 4, and it was what year was it? It was since, what was it? Since 2011. All right, since 2011, can you guys see that the price of coal has gone down? Okay, you will know when you read the data, I'm just kind of whizzing through this very quickly, that they are a big exporter of coal. It's one of their big commodities that they export. Okay, think about it. Really logically then, if the price of your exports are falling, the top of your fraction is going down, and therefore your terms of trade, are they getting better or are they getting worse? They're obviously getting worse. That's it. All you had to do basically is to give me two applications. One, I would get from the figure. So I would basically say that the price of coal has gone down from blah, blah, to blah, blah since 2011. Make sure it's since 2011, by the way, because that was exactly when they asked for. And the second is that if you look at the extract, it speaks about how a large percentage of their export earnings are from coal. I can't remember which extract it is. It's one of these, yeah. And as a result, the price of coal collapsing would result in a worsening in the terms of trade for Indonesia. It's as simple as that. There's nothing more to it. That's all you needed to do to get the 5 marks, yeah? Okay, now that hopefully that clarifies a little bit in terms of what terms of trade are, let's delve into economic development. And within economic development, I want to do two things. I want to talk about limitations to economic development, different theories that you need to make sure that you're familiar with, and especially because of the topics in economic development that I think they haven't asked for a very long time, and I'm surprised they haven't for a long time, especially big questions, are like the constraints to economic development, the limitations, the reasons why certain countries are lagging behind and why they're struggling to basically like catch up. Yeah. Okay. So let's go and share my screen over here. There are 3 theories I need to make sure you are extremely familiar with. And the third, we'll be talking about terms of trade at the end of it. The first limitation to economic development is, as hopefully you know, Paradoma savings gap. And let's talk about the Harodoma savings gap. Okay. Well, in a nutshell, the theory says that in many developing economies, one of the big reasons why economic development tends to be very low is that there is a lack of savings. But I need you to understand why savings are so low. And one of the big reasons why savings are really low is that in many of these economies, so if I take, for example, Somalia as an example, or Rwanda as an example, realistically, the GDP per capita, so the average earnings of someone in that economy, is extremely low, right? The average earnings of someone is so low. So imagine hypothetically, if I told you that you earn $10 in a day, do you guys agree the last thing you're thinking about is whether you're going to save any of that money? You'll be spending practically all of that income on basic necessities. You have what we call a very high marginal propensity to consume. Fancy way of saying, for every additional unit of income you earn, how much of it do you consume? Well, realistically, you're probably going to spend all of it because your income is so low that you'll spend all of your earnings. Now, this creates a problem because banks, how do banks make money? So, you know, when you put money in your bank account, let's say you bank with Barclays. When I go and save money in my Barclays bank account, Barclays don't sit there waiting for me to come back. Barclays go and lend that money out and they make loads of profit on that money by loaning it out. Yeah. And they invest it and do all sorts. Now, the issue is that if you're a bank and you look at a developing country like Rwanda and you see that hardly anyone is saving, are you going to want to set up in that country? The answer is a definitive no, because you're not going to make any money doing so. Therefore, even the individuals in the economy that have the means to save, that want to save, imagine if you have to walk 20 miles to get to a bank. Are you likely to do that on a regular basis? Well, obviously, the answer is no. Savings, therefore, are very, very, very low in these economies. Yeah. One other concept that I just quickly want to whiz through to explain this with, you might hear of a concept called capital flight. Let me just explain what that is, because it links to the savings gap. Capital flight is just a fancy way of saying that even the rich people in the economy are not leaving the economy, the money in the banks in that country. TNCs, for example, are not leaving their money in the banks. And that all contributes to the savings gap. So here's the problem. If I'm a business in Rwanda and I want to invest, I want to basically invest into like new technology, more capital machinery, whatever, yeah? Well, what do I need to do? I realistically go to the bank and borrow money. And from that, basically, I use it for investment. But if A, there are no banks, or if the banks have limited amounts of money in their accounts, is the interest they're going to be charged on these loans likely to be high or low? Obviously, the interest is going to be very, very high. They have hardly any money to lend out in the first place. So credit is very scarce. Credit is basically loans. There's hardly any money for me to basically get loans or to give out for loans, yeah? The problem then is this, is that a lack of savings leads to a lack of lending, and that leads to a lack of investment. And investment is fundamental to growth and development, because economic investment, like investment, results in both AD shifting out, but also LRIS shifting out. So in a nutshell, this savings gap could be summarized in the following chain of reasoning, which is low savings will lead to low investment, low capital accumulation, which is a really fancy way, by the way, of saying the rate at which the capital stock increases, like the number of machines that you add to your economy, and therefore low economic development. That is a fundamental theory for you to understand. It is so important for you to know it. So that is our first analysis if we've got a question about constraints to economic development. Now, let's evaluate it. Let's work out what might be the evaluations. And actually, I want to show you the evaluation. There are two parts to it. The first part is actually in the Indonesia question. So the 12 marker in the Indonesia question was about the benefits of aid. One of the benefits of aid is it can help to fill the savings gap. Let's understand why. If you give aid to countries, well, realistically, aid will come in the form of things like clothing, food, water, etc. Do you agree that that means these individuals in those countries no longer need to spend all of their limited income on those basic necessities? They can now save more easily. It's easier for them to save their income because of the fact that they don't need to spend all of it on basic necessities. Cool? That's a really solid evaluation that will work really well. I just want to show you guys another one that is outstanding. And it's from the old spec. There was a question about the like different African economies and growth rates in different African economies. And I want to show you about a particular question, which serves as a great evaluation to this. So if we go over here, let's go. June 2013, I believe, if I remember correctly. Unit 4. Okay. So here we go. Right, so in the June 2013 paper, they have an extract titled The Lion Kings. Here we are. Right, so here we are, The Lion Kings. Now, I'm not going to read the extract with you guys, but I want to show you a particular question that is a big, big, big hint as to what a great evaluation is to the Harrod-Domar savings gap. And it is all about technology. Yeah, it's there. With reference to the fifth paragraph, extract 1, analyze 2 benefits of improved technology for Africa. Right, can I explain why technology is such a great evaluation? Technology has advanced so much over the past like 15, 20 years that it makes it far easier for individuals in these economies to save. The vast majority of individuals in Africa now have access to a mobile phone and an internet connection. Therefore, things like Apple Pay. Do you guys agree that if I, for example, let's say I own a fruit stand, yeah? If I own a fruit stand, before I was only accepting cash payments, and therefore, in order for me to save and put money in the bank account, I'd have to lug large sums of cash from wherever it is that I'm basically selling my fruit from all the way to the bank. But now, if I now accept digital payments, if I accept like Apple Pay and credit card transactions and things like that, money instantly gets wired from my bank account or their bank account, sorry, the person paying me, straight into my bank account. Does it make it easier to save? Yes, it makes it easier to save. Therefore, this might not be as prevalent an issue as it would have been 20 years ago. Technology advancing helps to resolve the issue of the savings gap. Hopefully that's super duper clear, yeah? So that's our first analysis. Right, let's go back to the board and deal with number 2. The second analysis is also Harrod-Domar, but this time through a different lens. So Harrod-Domar model again, so HD, and this time it's called the foreign exchange gap. All right, let's talk about what foreign reserves are. Foreign reserves, in a nutshell, is other currencies. So in the UK, for example, examples of foreign reserves are like US dollars, real, any other currency outside of the pound are foreign reserves for us. And the thing is that foreign reserves play a really important role for 2 reasons. Number 1 is for trade. Now, this is where terms of trade is a big deal. Because if I look at a developing economy, so if I basically talk about, let's say, Ghana, June 2016 has an extract about Ghana and how their currency, the cedi, I may be butchering the pronunciation of that, but the cedi had majorly depreciated. Okay, let's work out what that does. If your currency is super duper weak, do you agree that it's very difficult for you to be able to import the capital, machinery, and technology required in order for you to grow and develop your economy? Is that fair? So therefore, if you have a really weak currency, it makes it more difficult for you to be able to import. And you need to import capital, machinery, and technology. If I had foreign reserves, though, if I had, let's say, US dollars, it wouldn't matter because even if my currency was really weak, I could just use my US dollars to basically import capital machinery or my euros to import capital machinery. But because they lack foreign reserves, whenever their currency depreciates, their terms of trade are declining. And as a result, they find it more and more difficult for them to be able to import the capital and technology. That's a big, big problem. Yeah. So that's the first issue with the foreign exchange gap, is the lack of foreign reserves makes it very difficult for these countries to basically import. That's an issue. The second problem is that many of these countries are in high levels of debt. And the debt that they are in is often quoted in which currency? US dollars. And this is why it's a problem. Because if I had foreign reserves, it wouldn't be such a big deal, because with foreign reserves, I could very easily just use my dollars to pay off my debt. But now every single time my currency, the weak currency, gets weaker relative to the US dollar, the real value of my debt, what it's really worth, increases. It's harder for these countries to service their debts. Example, again, just to clarify how everything kind of interconnects when it comes to macro. If I now show you guys paper 3, October 2020, I think it was. Let me double check. See, the 2020, 2021 was one of COVID years. Let's have a look. So, 2020, pretty sure it's 2020, but might be wrong. Let's have a look. Yeah, it is. All right, here we go. Right, Turkey. Very quickly, I just want to show you guys. So share screen there. Okay, look at this question for the October 2020 paper 3. It was an 8-marker. Examine 2 reasons why the Turkish government may want to avoid a significant fall in the exchange rate of the Turkish lira. Okay. If we take the assumption that Turkey has limited amounts of foreign reserves, look at what it says in the data. It has the following. There, bang. You see it? It says, Turkey is highly indebted in foreign currency. In other words, whenever their currency gets weaker, it becomes more difficult for them to service debts. They have to convert or sell more and more lira to be able to buy $1. And that's a big problem. So again, if you have limited foreign reserves, your debt load in real terms increases whenever your currency depreciates relative to the US dollar. Easy? Those are the 2 major issues with foreign exchange gaps. So number 1, again, to clarify, hard for you to import capital, machinery, and technology. Number 2, your debt levels increase in real terms whenever your currency depreciates relative to the US dollar. Problem. Let's evaluate it. How do we fix it? We fix it in 2 ways. The first way we can fix it is through tourism. Yeah? So if I develop the tourism sector, do you guys agree that those tourists that come to my economy, they come and spend their dollars, their euros, their pounds, whatever currency it is, and therefore there's suddenly a higher stock of foreign reserves in my economy. So that's the first way you can fix it. So countries like Kenya have managed to fix it this way. Turkey, to a large extent, actually has a pretty good tourism sector, so that's actually could be an evaluation there. So actually they could fix it. That's the first thing. The second thing that you could talk about is debt relief. Now, debt relief, for example, June 2023 has a 10-marker about the benefits to, I think it was Angola, of debt relief. Do you agree that if I'm given debt relief, it means that I no longer need to use whatever limited amount of foreign reserves I have to pay off my debts because I've been let off? And now I could use those foreign reserves instead to import capital, machinery, and technology. So in that question, by the way, it was a 10-marker in 2023. One of my benefits of debt relief is that it can help to fill the foreign exchange gap. That these economies no longer need to spend as much of their currency or limited amounts of foreign reserves on paying off the debts. Instead, they could now use it to import capital, machinery, and technology. Yeah? We will talk about tourism if we have time later today. If I don't have time, I highly recommend Unit 4, June 2017. There's a question, a 15-marker about tourism for Bolivia. I think that's a great question to do. It's one of the strategies they haven't really examined, and it's very easy for them to examine, especially in the light of COVID and how tourism would have been decimated by it. But anyways, we'll deal with that later. Right, number 3, third issue with these economies and why they struggle to grow and develop. It's on a new page. Number 3 is primary product dependency, PPD. Right, let's talk about what a primary product is firstly. A primary product is anything that is sourced from the earth. Another name for a primary product is a commodity. So commodities are often soft commodities or hard commodities. Example of soft commodities are like agricultural products, so like wheat, coffee, barley, etc. Hard commodities typically are like metals, so zinc, copper, gold, etc. Now, there are a couple of issues with this. The very first issue is that if you look at the price of commodities over time, so if I draw it out, so if I have time on the x-axis and price on the y-axis, typically commodities do this. They are very, very, very volatile. They go up and down pretty dramatically. And part of the reason why is that you have significant variations in seasons It could be like a good harvest, a bad harvest, right? The problem that you've got is that if you're a country that is heavily reliant on the export of a commodity, for example, the Ivory Coast with cocoa, they are majorly reliant on exporting cocoa. There's a whole extract about it, by the way. It was one of the COVID years. I think it was 2021, but it might be 2020, but whatever. Anyways, when the price of cocoa collapses to like over there, so let's say the price of cocoa is all the way down there, the problem is the vast majority of your workforce are employed in that sector, in agriculture. There's massive levels of unemployment now. Suddenly, the government tax revenue is on the floor. Economic growth is significantly declining. It's a really big issue. So when there's a significant fall in the price of your primary product, it results in major economic consequences like growth goes down, unemployment goes up, all of that. But then the alternative is also bad. And by the way, part of the reason why is that over here, PED is very, very inelastic. So if I told you the price of your commodity has gone down, demand does go up. So for example, there'll be more demand for, let's say, your cocoa. Is there going to be a dramatic increase, though, in the demand for your cocoa? Realistically, not. Therefore, there's a less than proportionate increase in the demand. Prices collapse. If I can quickly draw that out, prices go down a lot. Demand only goes up a teeny tiny bit. Therefore, your revenue is dramatically falling if you are exporting this commodity. Vice versa, by the way, the other scenario is, okay, let's say the price is all the way up there, so really high price. Okay, that really high price, you'd obviously want to sell a lot more of it because you have the incentive to make more money. The problem, though, is that commodities tend to be very inelastic in supply now, PES. Why? Because it's going to take a long time for you to actually grow your cocoa, to be able to extract more copper from your mine or diamonds from your mine or whatever the commodity is, yeah? Just as a real world kind of knowledge for you guys, the average maturity of a cocoa tree is 5 years. In other words, even if the price of the commodity goes up, let's say demand has increased for some reason, you still can't actually scale up your production significantly. Therefore, you're not in a position to make that much more money. Right. The overarching point, though, is this. The volatility of prices going up and down means that it will deter investment. Realistically, the farmers in these economies are unwilling to invest in large amounts because they don't know whether the next harvest is a good or bad harvest, whether they're going to be in business or not. This is a really big issue. And therefore, primary product dependency, because of the volatility, investment tends to be low. So economic development is also very low. Similarly, by the way, TNCs are less likely to invest in industries like this because they're too volatile. Yeah, so that's the analysis. That's the first one. The evaluation to that, there's a phenomenal evaluation. A phenomenal evaluation to that is to utilize something in the financial sector. I will talk about the financial sector in a lot more detail today, but within the financial sector, there are these things called forward markets. Okay, what are forward markets? A forward market is where you agree in advance to sell your commodity for a fixed price, and you are guaranteed to get that price regardless of what happens in the market. So imagine hypothetically that I am a cocoa farmer and I look at the forward market and I decide, you know what, okay, the forward contract price at the moment, let's say is $6. Make up a number, yeah? And I go, all right, you know what? Let me agree to sell my commodity 6 months from now at $6, yeah? If I sell it at $6, whatever happens 6 months down the line, so if the price of the commodity collapses to $1, doesn't matter, I'm guaranteed to get $6, I'm getting $6, no matter what, yeah? So therefore, do you agree that if I do that, I now can plan ahead with more conviction? Now, some of you might be asking, why in the world would anyone buy the contract? Well, the person buying it is probably a speculator. What they're hoping is that the price actually goes up to, let's say, $10. So if I got it, let's say, at $6, as soon as I basically get the contract or I get the cocoa 6 months down the line, and I sell it back into the market for a $4 profit. But anyways, forget the person buying it. We're dealing with the farmers. Do you guys agree that if I know I'm going to get $6 no matter what, it makes it easier for me to plan ahead? And therefore, investment actually could go up. It may not be such a significant problem now because of the financial sector enabling farmers to be able to plan ahead with more conviction. Clear? That is a sensational evaluation to that. An alternative evaluation, by the way, is buffer stock schemes. If you're not sure what they are, I have a video on YouTube for you to watch. Go and watch that. See how to draw the diagram. Just save time. That will help us, yeah? So that's the first issue with primary product dependency. Second issue, just in case it's a 12 marker in isolation, such as in June 2017, paper 3, question 1C, yeah? Anyways, it was a question about primary product dependency in Chile. The second analysis that I would draw upon is something called Prebisch-Singer. I need you guys to understand what Prebisch-Singer basically says. So this is Prebisch-Singer. The Prebisch-Singer hypothesis basically says that countries that are exporting primary products, like Chile with copper, are going to experience the deterioration in their terms of trade over time. In other words, what they sell to the world, what they export to the world, will allow them to import less and less over time. And the logic of Y is all to do with YED. Let's understand what that means. YED is, as your income goes up, do you demand more or less of a good? So we're assuming that the YED for both commodities, primary products, and manufactured goods are the normal goods. They're positive. In other words, as my income goes up, I'll demand more primary products, and I'll also demand more manufactured goods. However, according to the Prebisch-Singer hypothesis, the YED for commodities tends to be greater than that of primary products. Let's understand why. Especially, by the way, food, things like cocoa, coffee beans. If my income, let's say my income were to double tomorrow, am I going to double the amount of coffee that I consume? Am I going to just go on to some next level caffeine overdrive? Yeah? Probably not. Realistically, no. I would increase my demand maybe a little bit, but I'm not going to dramatically increase my demand for coffee. In contrast, if my income goes up, manufactured goods are things like phones, laptops, cars, yeah? I mean, you probably see from the quality of my camera that my laptop is very, very old. I've had this for about 8 years now, yeah? Therefore, if I were to go and buy another laptop, let's do some math together. Let's say my income goes up by 20% and I go and buy an extra laptop. That would represent a 100% increase in the demand for laptops for me. Is that responsive? Yeah, that's very responsive. In other words, the demand for manufactured goods is more elastic. It is more responsive to income increasing. Right, what does that actually mean then? Let's draw it out. You'll never need to draw this, by the way. This is just for your peace of mind and for you to understand it. If I put two countries side by side, yeah? So if I have this QP, QP. Okay, let's say Ivory Coast or over here, or Ghana. Let's just do Ghana, yeah? Here's Ghana. So they sell loads of commodities like coffee beans and stuff like that. And let's say over here we've got China, who are a big manufacturer. Okay, so we've got supply and demand like this. Okay. Okay, let's make our life nice and easy. And just for argument's sake, assume that the prices are equal to begin with. Okay. This one, D1. Okay, right. So I promise it's not a trick question. First things first. If Ghana export 1 unit to the world, in other words, if Ghana sell 1 unit to the world, how much can they buy? How much can they import in manufactured goods from China? Well, the answer is obviously 1 because the prices are the same. Yeah? In other words, whenever Ghana sell 1 unit at this moment in time, they're able to import and buy 1 unit from China who are selling manufactured goods. Okay. The thing is, though, is that incomes over time are practically always rising. There are very few exceptions to that. The financial crash, the Great Depression, etc. But other than that, realistically, incomes are almost always rising. Yeah. Now, the thing is, as incomes rise, we said that the demand for primary products will go up, but it's income inelastic. In other words, demand goes up only a little bit, something like this. So Ghana benefit because they can now sell their coffee beans, for example, for a slightly higher price of P2 over here. The issue, though, is that as incomes go up, the demand for manufactured goods for China's products, they don't go up a little bit. They go up dramatically because of the fact that it's income elastic or more elastic. And now notice that if I go back to what I said at the beginning, if Ghana sell 1 unit to the world, can they still buy 1 unit from China? Well, the answer is a definitive no. Their terms of trade, if we go back to that again, are therefore deteriorating. And the problem with having weak terms of trade as an economy like Ghana is that you desperately need to import capital, machinery, and technology. You need to be able to develop sectors like manufacturing, and you need technology and capital to do that. You struggle. You struggle because what you're selling is worth less compared to what you have to buy from the world. Yeah? That is the Prebisch-Singer hypothesis summed up, just like that. Yeah? Now, a couple of evaluations that will always work for Prebisch-Singer and generally for primary product dependency as well. There are 3 that I would lump together into one if it was a 12 or 15 marker. Number 1, the first thing that you could talk about is that there are examples of countries that have done amazingly well on the back of their primary products. There are 3 examples that I actually want you to remember. The first example is in Africa, and it is Botswana. Botswana are a major exporter of diamonds. In fact, the biggest jeweler in the world, De Beers, relocated from South Africa to Botswana about 10 years ago or so. Anyways, so they've done really well on the back of their primary products. That's first. The second is Chile. June 2017 paper, by the way. Copper, they've done really well through exporting copper. And the last thing, number 3, is the very obvious one, is United Arab Emirates with oil. They've done obviously very well through the export of oil. Cool? So that's our first kind of mini evaluation. Then the second thing we talk about is that economic theory will say that if you have a comparative advantage in the production of a primary product, what should you do? Well, according to economic theory, you should be specializing. because you have a lower opportunity cost in the production of that good. Now, why would Ghana, for example, have a comparative advantage in something like cocoa beans? Why would, for example, the Ivory Coast as well? Why would Brazil have a comparative advantage in coffee? The answer is very simple, is they have the right climate to grow that commodity. Olive trees, for example, in Italy. If you have a comparative advantage, then could you specialize? The answer is yes, you should. Because if you specialize and then trade, it will result in a more efficient allocation of your resources and global resources. Therefore, these countries specializing in their primary product is what economic theory says they should basically be doing. Is that clear? That is another evaluation that you could do. The very last one is to basically throw in some real world knowledge. Between the year 2000 and the middle of 2010, middle of 2008, so up until the financial crash, basically, the price of commodities were actually booming, whilst the price of manufactured goods were falling. You don't really need to know why. Just to clarify why, it was because of China, by the way. China was selling a lot more manufactured goods. The supply of manufactured goods was flooding the market. Prices go down. And they were also demanding loads of oil in order to fuel, basically, the manufacturing sector. But anyways, in a nutshell, think about it. If you're exporting a commodity at that time and importing manufactured goods, your terms of trade were amazing. It was the opposite of what Prebish Singer was saying, because your exports would have been worth so much and your imports were worth a lot less. And again, real world knowledge. I get this question about, oh, where do I derive real world knowledge from? Real world knowledge is derived not from spending hours and hours on Google or ChatGPT or wherever. Real world knowledge is gained from past paper data response. It's all there for you. Can I show you an example? As if I would know this if I hadn't gone through a past paper or all the past papers. In the Unit 4 paper that I was showing you a second ago about Africa, the example I want you to remember is this. Angola, who are a big exporter of oil, their economy grew at an average annual rate of 11.1% between the year 2001 and 2010. Here you go. There we go, Angola. Yeah? You guys think I know that? Do you think that I just spend like hours going, oh, let me find out about Angola's economy? No, I know it's hard to believe, but I have a life, yeah? But this is the thing. As you do loads of past papers, you will gain real world knowledge from data response. Use your data response as your real world knowledge. That is the greatest way to get real world knowledge, in my opinion, yeah? So anyways, that would basically indicate, hey, countries that were primary product dependent, like Angola, were doing pretty damn well. So Prebish Singer, have some of that. Those are our three analyses and constraints to economic development. And here is the evaluations. Easy peasy. Let's go. Next. I will deal with the strategies to promote development very soon. But before that, I want to go on a tangent and I want to talk about the financial sector. And I want to do two questions. So let's just go. The starting point is really basic stuff. And then I will delve into the financial crash, what happened and why it's relevant and all of that. Let's begin with the financial sector. There are only realistically two questions that they can ask you about. The first question is the role of the financial sector. And the second is market failure in the financial sector. I will deal with that eventually. Let's begin with the role of the financial sector. The financial sector has 5 roles that you need to know about, and they're very straightforward. Number one is to facilitate savings. So it makes it easier for individuals and businesses to save. Number 2, to facilitate lending, right? It obviously is a lot easier for me to borrow money from a bank. I can basically go take out loans. Businesses can take out loans. And of course, we can talk about how that helps investment. Number 3, the third thing it does is it facilitates the exchange of goods and services. You guys agree that nowadays most transactions are done digitally and you can get a lot more transactions taking place because of the financial sector. It connects buyers and sellers really easily. Number 4, forward markets, which we spoke about earlier today. So the idea that you in advance can sell your primary product. It can also be for foreign exchange, by the way, June 2019. Because if let's say I'm a big trader and I export and import a lot, the last thing I want is to be uncertain about what will happen to the exchange rate. Because if suddenly the pound collapses, it's suddenly going to massively impact the value of my exports and the value of imports. So what I do is I engage in a forward contract and I agree in advance at a fixed exchange rate. The very, very final thing is it provides a market for equities, right? What are equities? Equities are basically like shares in a company. So if I'm a business, I might give away a percentage of my business in return for people basically funding, giving me like loads of money that I could use for normally to grow the business, but it doesn't have to be. So there's that. And why would you invest in a business? Well, you're hoping that the business is successful. And by owning shares, you're able to basically now get the dividends and earn profits, basically. Yeah. Okay. Right. Let's just do 2 things. That is what you need to know in terms of the role of the financial sector. I'm going to show you guys a Section 8 question. And then I'm going to show you a 15 marker that a lot of people found very difficult. And we're going to answer it together. Let's start with the Section 8 question. Sorry, screen. Okay, so paper 2, June 2022. Let's open up here. Okay. So in section A of paper 2, we have the following. Question number 5 says this. There we go. In May 2020, the UK government introduced a loan scheme to help small businesses survive the downturn in the economy. Small businesses could borrow up to £50,000 at an interest rate of 2.5% for up to 6 years from a bank. The government guaranteed 100% of the loans to enable banks to issue them quickly, and only minimal checks were made on borrowers. With reference to the information provided, or above, explain one role of the financial markets. I mean, I think the answer is pretty straightforward. Obviously, here is facilitating lending. Banks basically provide credit for businesses, and these loans can be used to invest. In this case, it was helping businesses that potentially were really struggling because of COVID. The clue is that survive the downturn in the economy. Yeah. So all you're doing is you're identifying that it's facilitating lending. You're giving me an application mark. Because remember, in section A of your paper, if it's 3 or 4 marks, at least 1 mark, or 1 mark is reserved for application. So I would quote the fact that it's to help them survive the downturn. And just explain that these loans can be invested and allow the business to grow. It could allow them to become more dynamically efficient. I know that's very micro. It's okay to bring micro into macro as long as it's not like an AS. You're not going to draw like Costanrodi diagram, sorry. Yeah, that's it. So that's a really easy question. So let's hopefully that's a nice little warm up. Let's now dive into a much harder question. A much harder question of June 2018. And June 2018 serves as a very important lesson for all of you guys because of 2 things. Number 1, so if I look at the 15 marker, it gone past it. It looks like this. Discuss the role of the financial sector in the growth and development of developing countries. Okay, let's chat. First things first. What was really important to note if you've done this paper is how rubbish the data was. The data was so useless for this particular question. So people were like, what in the world? Where do I get my application marks? Your application marks can also be earned from your own real world knowledge. That's the first thing to notice. The second thing is that this question, because people found it difficult because it was like combining 2 topics. It was economic development alongside the financial sector. So what I do is I take a step back and I would plan it. So let's do it together. The first thing I would do is what I've already written on my board, which is I go, okay, what are the roles of the financial sector? What does the financial sector do? Well, it facilitates savings, it facilitates lending, all of that. Then I go to myself, what are the limitations to economic development? What are the constraints? What are the things holding back these economies? So let's do it. Number 1, do you guys agree we basically said the savings gap, Harodoma? Number 2, we talked about the FX gap, foreign exchange gap. Number 3, we talked about primary product dependency and like volatility of prices, Harodoma, Prabhishsinga, etc. Okay, it should hopefully be very easy. All you have to do now is you match it. What you do is you go, there's a lack of savings. Well, banks help to facilitate savings. Okay, so the analysis number 1 is written for us. What we do is we do this. We do 3 layers. The first is the topic sentence, which clearly answers the question. It will be something like, one way in which the financial sector can help promote economic development is by facilitating savings. I want the examiner to clearly know my point immediately. 1. The next thing that I now do is I identify the problem. I go, according to the Harodoma model, many developing countries, such as Rwanda, have very low savings rates. This is problematic as firms struggle to borrow money for investment, and I explain that investment is therefore low. Not too much, though, because you now want to explain how the financial sector can resolve it by facilitating savings and making it easier for individuals and firms to save. Banks can now lend out more money to individuals and to firms, and then investment is likely to go up. And then it's easy. Why is it easy? Because now I can go, investment is a component of AD, and therefore a rise in investment is likely to shift AD outwards. Investment is also, and hopefully you know, injection into the circular flow of income. And so there is likely to be a positive multiplier effect. Right, really quickly, I will come back to this. Can I quickly go on a tangent and explain the multiplier effect? I need you guys to understand as an extra bonus analysis whenever any of the injections, and the 3 injections are government spending, investment, and exports. Any of these 3 go up, you can always say that it would lead to a positive multiplier effect. Can I just talk about what the multiplier is really quickly? So let's just go up a little bit for a sec. The best way to understand the multiplier is with an example. Now, I know in our question, it was about investment that we just talked about. It's just easier to understand it in regards to government spending. So imagine that the government decide to spend let's say 600 million pounds. Okay, so I'm gonna depict that by the letter Y. The reason why is because I'm saying imagine all of that spending was on creating jobs in the public sector. So hypothetically, let's say that they are creating jobs for nurses, doctors, police, whoever. Yeah. Those individuals that now have an income that they may not have had before or a higher income than they had before, what are they going to do with their income? Do you guys agree that their income going up means they're going to obviously spend more in the economy? Consumption, in other words, is going to now rise in the economy. So consumption goes up, but they're not going to spend all their income. They're not going to spend all 600 million pounds. They're going to spend, let's say, 450 million pounds of the 600 million. Now, do you agree as a result that that translates into there being more demand for goods and services and businesses are making more money? Are they hiring or firing workers? Well, to cater for the extra demand for goods and services, there is more demand for labor because labor is derived demand. In other words, let's say businesses now firms make another 450 million pounds. They will now go and essentially hire more workers. But again, they're not going to spend all 450 million pounds hiring workers. What you now do is, let's say they spend, I don't know, 200 million. But what happened? I depicted that by the letter Y again, because another round of income has just been generated. Yeah. And again, what we basically say is that means that there's more income in the economy. Those people have money. What do they do with their money? They spend it. Let's say they spend, I don't know, 200 million pounds, say 80 million pounds. Yeah. So that's consumption. Again, going up. Easy peasy. And so on and so forth. Businesses will hire, let's say, an extra 30 million pounds worth of workers. Eventually, the number will fizzle out. But do you guys understand that what's happening is that initial injection of 600 million pounds, it led to multiple rounds of income being generated in the economy. That is the multiplier. That is it in a nutshell. Now, you guys also need to basically be able to do the maths behind it. It's very basic, but the maths is 1 over 1 minus MPC. The only reason I want to quickly talk about it is because if we're dealing with a developing country, a bonus point is this. If you're not sure why, plug in random numbers. Try like 0.2 for MPC and see what number you get. Try 0.8 later and see what you get for the multiplier. But in a nutshell, the bigger the marginal propensity to consume, the bigger the multiplier. And in developing countries, is the MPC likely to be high or low? Well, realistically, it's likely to be high. So the multiplier will be big. But anyways, I don't, that's just like extra, just for you to know. But anyways, back to what we were saying. We were saying that banks setting up in these economies like Rwanda will allow people to save more easily. Higher savings leads to higher investment. Investment, AD shifts out, injection, multiplier, growth. And you can link it back to economic development. Is economic development, HDI is broken up into 3 sections. There is education, healthcare, and living standards through GNI per capita. So even when there's growth, as long as you then say the HDI ranking rises, you are answering the question in terms of economic development. Cool? That is our first analysis. Let's evaluate. Anyone got an amazing evaluation? Because there is an amazing evaluation. I worded my analysis in a very particular way on purpose. Let's see. The evaluation is the issue, really, the underlying issue is not resolved. The underlying issue is that the GDP per capita in these economies is really low. They lack the money to save. If I put a bank in the middle of a slum in India, it's not like people are going to go, oh, there's a bank now, I'm going to go start saving. If I earn $10 a day, I'm not going to suddenly start saving just because there's a bank nearby. The problem is not therefore resolved by the financial sector. Just because banks set up in these regions doesn't actually resolve the issue itself. This is now where you can use the data. And again, application marks are not reserved for analysis. You can get application marks from anywhere in evaluation as well. So if I quickly share the screen for that extract, we look at figure 1. Here you go. Figure 1 shows the proportion of the population in absolute poverty. Look at sub-Saharan Africa. Sub-Saharan Africa in 2012, roughly nearly 50%, about 45% of people are in absolute poverty. Absolute poverty is living on less than $1.90 a day. Who cares if a bank sets up in that region? Are they going to save? Of course they're not going to save. And therefore, it doesn't actually resolve the issue. And that is a phenomenal evaluation to that. Clear? Let's go second analysis. Second analysis now. Again, I need to go basically to my, what are the limitations? What are the issues? Or what are the roles of the financial sector? There's an obvious match. Prime product dependency. We did it already. We solved it with forward markets. Make sense? Forward markets basically resolve this. I already did it earlier, so go back in the video later on when you revise off this. But that is the analysis, right? The evaluation is not that straightforward. If you look at the mark scheme for this question, by the way, the evaluations are pathetic. They're so lame. And it's normally a sign that it's a difficult question, and they're normally a bit more lenient. What you can always do is you can identify other limitations that are not resolved, even if you basically have the financial sector in place. One of the ones that I think make a lot of sense is that literacy rates in these economies are still very low. The education is still lacking. And the problem that you have with that is that instruments like forward markets are very complex financial products. Therefore, how many of them realistically are actually going to utilize forward markets? The uptake might be low. And if the uptake of forward markets is low, this isn't going to resolve the issue. Does that make sense? That would have been a valid evaluation. Alternative evaluation is maybe like corruption is so high that actually banks will just not set up no matter what. They don't want to set up in countries where corruption is high. But honestly, I think the one about education being low, literacy rates being low, and the financial instrument being so complex is a pretty solid evaluation there. And it'll get you the majority of the marks, yeah? Cool. That is our starting point. Let's now do the other part of the financial sector. And it is the harder part of the financial sector, and it's simply the market crash, like the market failure in the financial sector. Yeah. So let's describe what happened in the financial crash. If you know what this is, just listen up for a couple of minutes. But I need everyone to actually understand, to the best of their ability, what happened in terms of the financial crash of 2008. In order for us to actually understand the financial crash of 2008, we actually need to go back to the year 2001. In the year 2001, there was a recession in the UK and in the USA. It was called the dot-com bubble. A bubble is where an asset is overvalued, and as always, bubbles pop, and those assets basically decrease in value dramatically. Now, the reason why it's called the dot-com bubble is because I know in 2025, it sounds ridiculous to us, but in the 1990s, the internet is a very new thing. And so investors are easily impressed by any business that has a website. They're like, oh my God, you have a website. Wow. So they're now investing tons and tons of money into these businesses that really are very bad businesses. But just because they have a website, they're like, wow, you have a business. That's crazy. You have a website, sorry. Yeah. Now, obviously, loads of these investments are completely rubbish and loads of these businesses go bust. So what happens is there's a recession. Okay, let's do some macro revision. If I am in a recession and you are the central bank, what kind of interest rate do you think you need to set to stimulate economic growth? Well, the logic is this. If I look at it on an ADAS diagram, let's work it out together. So here's real GDP, and here's the price level, yeah? Okay. So if I am experiencing a recession, let's say economic growth is really low over here, Y1, and this is the price level. Which direction do I want to shift aggregate demand? Obviously, I want to shift it outwards. How do I do that? Well, the way you work it out is to ask one question. If you think interest rates are going up or you think they're going down, you just ask yourself, okay, let's say I raise interest rates. If I raise interest rates, are people going to save more money or less money? The answer is higher interest rates will incentivize people to save more money because they would get more return on their savings. The rate of return basically is higher. If I save more, then consumption would fall, AD would shift in. So it's obviously not that. The answer is you would lower interest rates. Yeah, I'm going to reduce interest rates because if I reduce interest rates, what does that do? Causes AD to shift out, and I get economic growth as a result of it. Yeah, that is what exactly they did. So in 2001, the Federal Reserve, which is the central bank in America, cut their interest rate, the base rate, to 1%, which is a very, very low rate of return. Yeah, right. Investors, one of the investments they take out are things called treasury bills. You guys don't really understand that. All you need to know is the interest that they're going to get on it is now 1%. If you're an investor, then is that an attractive rate of return or is that a pretty rubbish rate of return? Well, it's a pretty rubbish rate of return because 1% is not that great. So they're looking around trying to find a better investment for them to grow their money. And this is where investment bankers come up with what they think is a totally genius idea. They're like, do you know what we can do? We can try and connect homeowners with investors. And the way that we're going to do that is the following. So let's walk through how someone buys a house. So let's say I want to go and buy a house, yeah? So I apologize, my art is absolutely shambolic. I'm going to draw a stick man. Here I am, yeah? Give me some hair, yeah? Here's my hair. And I want to buy a house, okay? Now, I obviously cannot just pay for the house in cash. I don't have enough money. Let's say hypothetically that house happens to be worth £800,000, okay? What I will do is I'll go and find a lender. A broker might connect me to a lender. And the lender, provided that they accept my mortgage application, will now go and pay on behalf of myself the majority of the asset value. So let's say they go and pay £700,000. I put down £100,000. They pay £700,000 towards this house. Yeah. And now I get this piece of paper. It's a mortgage, which says I'm going to pay you back, the lender, £700,000 every single month for about 25, 30 years, plus what? I basically, obviously, I pay interest on top of it. From the bank's perspective or the lender's perspective, it makes sense because they're going to make way more than £700,000 over 30 years. But from my perspective, it also makes sense because I wouldn't have been able to buy the asset. Right. In a nutshell, though, just remember that every single month, whenever I basically am paying my interest and paying repaying the mortgage, money's going into this mortgage. Yeah. So money goes from my account here to repay for my house. Okay. Investment banks now call up these lenders. They call them up and they're like, we want to buy these mortgages off you. We'll buy it and obviously give you some commission on top of it. So we'll pay the £700,000 right now. We'll absorb that risk and we'll give you a little bonus on top of it. Let's say like 50,000, 100,000, whatever it is. It doesn't actually matter. Yeah. And what they now do is they package together all of these mortgages into this thing called a CDO, which stands for Collateralized Debt Obligation. CDO. Right. The best way to understand a CDO is through this analogy. Again, I apologize for my atrocious art. We're going to draw a cup. Yeah. And imagine this cup is made up of 1,000 mortgages, yeah? And the way to understand it is this. Imagine that if all 1,000 people pay into that mortgage, the water is represented by people paying their mortgage, fills this cup, and so the whole cup gets filled up, yeah? So what they now do is they say, okay, so these CDOs, 1,000 of them, or 1,000 mortgages, sorry, make up that CDO, and we can slice it up into 3 sections. The first section is going to be safe. Why is that safe? Because imagine that of the 1,000, only 200 people need to basically pay their mortgage on time that month for me to basically get paid out if I've bought a safe asset or safe slice of a CDO. Then you've got medium, because medium only gets paid out, let's say, if of the 1,000 mortgages, I don't know, let's say 700 have paid their mortgage on time, because not everyone's obviously going to pay their mortgage on time. And then we've got high risk over here. Like high risk is, let's say all 1,000 people need to pay it out in order for you to get paid. Right. The thing about this, which is clever, is that by slicing up the CDO, so that you can now target specific institutions based on their risk appetites. What does that mean? There are certain financial institutions that are very low risk, like a pension fund. Pensions do not want to take loads of risk. Therefore, they're going to buy loads of these safe slices. And the return they might get on this investment is about 4%. Medium risk is typically other banks. So other banks might get a return of, let's say, 7%. And finally, high risk are like hedge funds. They're risk takers. They basically would get a return of, let's say, 10%. Okay. And the thing is this is amazing to begin with. And the reason why this is phenomenal to begin with is because realistically, most people that have a mortgage pay their mortgage on time. So therefore, money keeps flowing into this like CDO and people keep getting paid out. So if I pay, let's say, bought £100,000 worth of CDOs, I keep getting a 4% return on this investment. This is amazing for me. Yeah. So right now, investors are like, this is the best invention you have ever come up with. This is phenomenal. And what they now do is they start calling up the investment banks. And they go to the investment banks, they're like, please, more CDOs. We want to buy more CDOs. This is the best investment ever. Yeah. And if you think about it, what they now do is they go call up the lender. They go, do you have any more mortgages that we can buy off you? But the lender's like, well, no, everyone that qualifies to get a house has a house. We can draw this in a very simple supply and demand perspective. So I draw supply and demand over here. I have supply, demand like this. Imagine that this is the average price of a house in the USA, also the UK, but the USA in particular, where it's this, P1, Q1, okay? And everyone that's entitled to basically get a house realistically has a house. So we're at equilibrium. But the thing is these investment bankers are desperate to package more CDOs together so they can then sell it and make loads of profit. So what they now decide to do is they go, do you know what? Let's start taking risk. Because if you think about it, if I lend out or give out a mortgage to someone and then they default on their mortgage, what happens? So if you go back to the example of me, yeah? So let's say they gave me a mortgage of £700,000 on my asset, which is worth £800,000, yeah? And now let's assume that because they just want me to get the mortgage, they don't do things like credit history, and they don't check my income, they don't even ask for like a deposit, they'll pay the entire £800,000 on my behalf for the majority of it, yeah? Because in their mind, they're like, it's fine. Asset prices like houses are always on the rise. So even if, let's say, hypothetically, I have the house and then a year later I default, meaning that I now cannot actually pay it back, what happens? I now basically default, and otherwise they repossess my house. They go and take back my house. And in that time, the value of the asset could have risen to £810,000. No problem for them. Therefore, what they do is they now put it back on for sale, make their profit, and as soon as they sell it and they have a mortgage, they repackage the mortgage into the CDO. The problem, though, is this. The problem, though, is from a supply and demand perspective, if suddenly people who would not normally be given a loan, people who would not normally be given a mortgage are now being given a mortgage, what is shifting? Demand is shifting outwards. And the reason why demand is shifting outwards is because now consumers in the market have entered that were not there before. Subprime mortgages is the fancy way of describing mortgages given to people that realistically can't repay it, that would not normally be given a mortgage, because they're not checking things like your credit history. They're not checking things like, your income earnings. So now the price of the asset has appreciated, and we now have a bubble because the value of houses is a lot higher than it really should be. And now suddenly there's a big issue. And the big issue that arises is obviously loads of these people start to default, right? They obviously can't pay these mortgages back. Now, if one person were to default, so let's say on your road, if one house went up for sale, well, one house going up for sale is not that big a deal because there's only a small increase in supply. Demand probably matches it. If, though, of the 10 houses on your road, let's say 9 of them now all go up for sale simultaneously, what's now shifting? What's shifting is supply. And if you think about it, when supply shifts, what happens? Well, the bubble pops. The value of your assets now start to go down. And house prices are no longer rising, they are going down. This creates 2 key problems, which we can use in a moment to construct a really cohesive essay. Yeah? So, the first cohesive essay, hold on, so I just need to do my TikTok thing so it doesn't go off. Yeah, right. The first cohesive point is this, is that individuals like myself may start to now suffer from something called negative equity. Right, let's explain what that is. So imagine that I was just unlucky enough that I bought my house in the middle of the bubble. I had no idea there was a bubble, but I still have my income. I can still continue to afford to pay the £700,000 mortgage, but it turns out that my house is not worth £800,000. It turns out that my house is worth £200,000. Right, negative equity is the idea that the mortgage that you're paying, the £700,000 that you're paying back on your mortgage, exceeds the value of the asset. In other words, even if I went and sold my house today, do you guys agree that I still owe the bank £500,000? That's a really big issue. Labor, therefore, by the way, becomes geographically immobile. If I have a job available for me, let's say in Leeds, I can't relocate there because my house, if I sold it, I'm still in debt. This is a massive issue. But the second problem on a macro basis is this, is that if you think about it, individuals are now suffering from negative wealth effect. Wealth effect is the idea that your assets determine your confidence level. And if your confidence is now negatively impacted, obviously it is because your house prices are worth a lot less than you thought it was, consumption in the economy is going down. But I'll deal with that in a second. Before it, what did those people do? Those people that could afford to pay their mortgage, let's say I could afford to pay my £700,000 mortgage, but the asset is only worth £200,000. What do you think I did? The other people who could afford it, they also default. They turn around to the bank and go, have the house. I don't want the house. Default on the asset. And suddenly now, even those individuals that can afford to pay their mortgage are also defaulting. Supply, if I just draw it again, I mean, I could do it actually. Supply is shifting outwards again. I have no space over there to show you. House prices are in free fall. They are collapsing because it isn't just the subprime mortgages that are defaulting. It's also the prime mortgages. The people that can actually afford to pay their mortgages are not paying their mortgages because it ain't worth it for them. 2 problems. Banks have just given out all these loans. And if you're a bank, not only have you given out all these loans on these assets that you thought you're going to get back £700,000, £800,000 for that asset, all you're getting back is a house worth £200,000. You're losing money left, right, and center. Second problem, though. You know what the problem is? Second problem is, remember how CDOs pay out? CDOs pay out if people pay their mortgages. Who's paying their mortgage? Absolutely no one is paying their mortgage. Even the people that can afford to pay the mortgage are no longer paying the mortgage. And institutions like hedge funds, like investment banks, all sorts of institutions have bought billions of these CDOs, but they are worth nothing. They literally are worth absolutely zilch. And now there are several key issues that we need to address. Number one, if I got a question about market failure in the financial sector, one of my go-to points is the fact that bubbles were created due to banks basically taking on excessive risk. The excessive risk led to house prices appreciating in value because they were giving out subprime mortgages. Bubbles always burst. And when they burst, this resulted in a really significant negative wealth effect. Negative wealth effect results in low confidence and consumption dramatically falling. AD therefore shifts inwards like mad. Economic growth contracts like crazy. Unemployment skyrockets. This is exactly what happened. Is that a problem? Clearly that is a problem, right? So that's going to be one of our analyses. The other thing, though, is the government had to bail these banks out. They couldn't just let them collapse. And this is where 2019, I'm going to do it with you guys in a second, was a question about whether it was appropriate for the government to bail out the banks. Yeah, it was, because if they didn't bail out the banks, then there would have been your savings, the money in your bank account would have gone bye-bye, and therefore consumption would have gone down even more. But the government bailing out the banks, do you think that's cheap, or do you think it's really expensive? It's extremely expensive. And as a result, the UK's fiscal deficit and national debt skyrocketed. It went up like mad. If you look at data, June 2017, paper 3, look at question 2B, it has a fiscal deficit and national debt. UK national debt as a percentage of GDP goes up from approximately 35% in 2007 to 60% in 2009. Do you understand how big that is? Like, that is a massive increase, yeah? That's a big problem. And do you know the other problem that you need to talk about for a question like that? Moral hazard. Moral hazard is the idea that if you bail out the banks, as they did, they develop the expectation that they will get debt relief again in the future. Therefore, these banks are very likely to take on excessive risk again, knowing that the government will save them. No matter what happens, the Bank of England, or the government, sorry, in this instance, will save them. They will not allow them to collapse because they're too important. Is that really clear? So my 2 key points. 1, negative wealth effect as a result of bubbles bursting. Number 2, fiscal deficit, national debt, and also moral hazard are excellent analyses, yeah? These are really strong points. Evaluations are a bit more difficult for this. I think what you could do to evaluate is to talk about how, for example, when the government bailed out the banks, eventually they sold Lloyd's to Northern Rock, they reclaimed some of their money, the economy eventually recovered, etc., 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 yeah? But anyways, the point is not that. I just wanted to make sure that you guys really, really understood the financial crash. Now that we understand the financial crash, we'll hopefully have a better understanding of the financial crash. Let me show you another question about the financial sector that they have asked. Make sure you know how to answer it. And it comes down to like being clever with the wording of questions to make it easier for yourself. So let's do June 2019. Okay. June 2019 has a 15 marker, which is not too nice. Let's deal with it. Oh, gone past it. In June 2019, the 15 marker says the following. Discuss whether providing substantial government financial support to banks is the best policy response during a financial crisis. Okay. This is one of the rare occasions where I think the evaluation is a lot easier than the analysis. The analysis is really difficult here. And I think there's a clever way of dealing with this. The clever way of dealing with this is to go, okay, if I'm going to make the case that the government should have bailed out the banks, that the government needed to provide financial support, what I can do is I can run the examiner through a scenario where they did not bail out the banks, explain how catastrophic that is, and then at the end go, therefore, it is obviously necessary for them to bail out the banks. Yeah? Let's deal with it together. So out loud. Yeah? First things first. If they had allowed the banks to collapse, we said, do you agree that savers, their money bye-bye? Yeah? Therefore, consumption in the economy would have dramatically increased. To make matters worse, house prices, as now you know, were already falling. So people were already experiencing a negative wealth effect. Consumer confidence was already very low. Therefore, consumption was already falling. If you had allowed the banks to collapse, consumption, the biggest component of AD, it wouldn't have just fallen. Consumption would have gone into utter freefall. You can draw an LRAS AD diagram, by the way, with AD shifting in like mad, like exaggerator, and show that the economy fell into recession, by the way. It would have fallen into something called a depression, which is like a prolonged recession. Now, if you don't want to talk about depression, it's okay. You can just say basically like a really significant and sustained recession. Okay, do you agree? That's really bad. Do we want that to happen? Well, obviously not. We don't want savers to lose their money. Therefore, did the government need to bail out the banks? Well, obviously, yes. Obviously, the banks absolutely needed to be bailed out because you don't want that to have happened. That's our analysis. That's number 1. Let's eval. Evaluation is really straightforward. Moral hazard. These banks are going to expect to get bailed out again, and therefore they're going to start taking crazy risk again in the future, and the government probably going to need to bail them out again. That's amazing. Second analysis, right? So the first analysis was through the lens of the consumers or individuals, us. Let's deal with businesses. Remember earlier I said that I always want you to think of investment as firms borrowing money from banks in order to invest. 2 things. Firstly, if banks collapse, are there more or less banks for me to borrow money from? Obviously less. But also bear in mind that banks are already very reluctant to lend. This is why it's called the credit crunch, by the way, that businesses, banks like HSBC, Barclays, Lloyds, these guys, they basically start restricting credit. They're worried about lending, yeah? Because they lost so much money lending subprime mortgages, CDOs, all of these toxic assets that they basically lost all that money on. So they're really reluctant to lend. If now banks collapse, you guys agree, what happens is that it becomes so difficult for you as a business to borrow money. And if you struggle to borrow money, investment is likely to take a big hit. And if investment falls, there are two significant issues. Number one, investment affects your competitiveness on a global basis. So your economy becomes less internationally competitive. But number two, you know what? Let me quickly share my screen to just show you guys something. One of the small definitions that you should know about from theme 2 is the difference between gross investment and net investment. Let's just go through it in very simple terms. Gross investment is simply an increase in the nominal capital stock, right? Let's just go through a really easy made up example. Imagine that in our economy, we have, let's say, 10 laptops. So let's assume that that's our capital, yeah? And we decide to add 2 more laptops. So we have 12 laptops now, okay? So what was the gross investment? Well, gross investment was +2. We just added 2. But that's a rubbish definition, or a rubbish like indicator. Why? Because really what we need to know is net investment. Net investment is a very basic formula, and it goes like this. Net investment is equal to gross investment, so the 2 that I just did a second ago, minus capital depreciation, right? What does that mean? Capital depreciation is basically the machines in your economy that no longer work or no longer used, yeah? Okay, so going back to my example, if we add 2 laptops to the economy, but what if I told you that of the 10 laptops that were there before, let's say 5 of them stopped working. 5 laptops are no longer functioning. They've died, yeah? Okay, what's the net investment? Well, if I do it, I get 2 was the gross investment, minus 5. My net investment is -3. This therefore results in net investment being negative if I now go back to our question. In our question, we said that if banks were allowed to collapse, what might happen is that firms would struggle to borrow. And if firms struggle to borrow, they struggle to invest. And if gross investment is now outpaced by capital depreciation, then net investment becomes negative. And if net investment becomes negative, your LRAS curve could shift inwards. I'm going to draw it. Because if you have LRAS shifting inwards, something really bad happens. So let's draw it out. Got real GDP over here. Price level over here. So if I've got LRAS 1 here, and let's say like AD is here. Okay. When you have an inward shift in the LRAS curve, technically speaking, by the way, it starts at a higher point on the y-axis. If you start at the same point and shift it inwards, I don't mind. Let's do it probably how you guys have seen it in school. So let's do it this way, which is it does this. Yeah? LRAS2. Well, the new equilibrium is here. You guys see that we clearly get negative economic growth, but we also get something else. We also get inflation at the same time. Do you know what that's called? That's called stagflation. It's stagnant economic growth where there's like negative or very low levels of growth combined with higher levels of inflation. Living standards are on the floor, yeah? Anyways, in a nutshell, your key point is to say that they needed to bail out the banks because otherwise businesses would have collapsed, businesses would have struggled to invest, and you develop it that way. The evaluation, the government spent billions of pounds bailing out the banks, and it says it in the data, by the way. So if you look at the data very quickly, 65 billion pounds was spent bailing out Lloyd's alone, yeah? Therefore, fiscal deficit goes up, national debt goes up, and your credit rating could get downgraded, yeah? I will talk about credit rating in a second, but where are we? Here we go. So they said that they bailed out, there we go, 65 billion pounds of taxpayer bailouts during the financial crash, yeah? So fiscal deficit, national debt, credit rating, that's the financial sector in a nutshell, yeah? Hopefully that's really, really clear in terms of what you needed to basically do, yeah? All right, cool. Let's delve into something totally different. I just want to talk to you guys very briefly about government bonds and government spending and everything else around government bonds. Government bonds are the way in which the government borrow money, yeah? And the way it works is this. Imagine I am the UK government. I issue this thing called a bond. It's essentially an IOU. Let's say you buy the bond. What's happening is, let's say the bond costs £100. You, in essence, are lending £100 to the government. And in return, you get this thing called a bond, which says, I, the government, I'm going to pay you back the £100 that you just lent me, plus what? Plus interest. Yeah, so if you, this is you basically lend the government £100. In return, you get this thing. And they say to you, we'll give you £100 and we'll give you, let's say, 3% interest on that. Yeah? Right. It's a great way for the government to borrow money. Now, important for you to just understand one thing. there is an inverse relationship between the price of a bond and the yield the bond pays out. The yield is the interest rate. Why is that important? If I look at like a really safe economy, so if I look at a country like, I don't know, Switzerland, yeah, you'd expect the demand for their bonds to be very high and the price also to be very high because of the fact that they're super duper safe. And if their bonds therefore are high in price, is the interest on the bond high or low? Well, clearly high price, low yield. Why? Low interest because you know you're going to get your money back. It's a very low risk investment for you to make. Therefore, realistically, you're going to get your money back. Vice versa, by the way, if I let's say take out a loan or give a loan to like I don't know, Rwanda. If the Rwandan government give out a bond, is the demand likely to be high or low? Well, the demand is likely to be pretty low. The price, therefore, also is likely to be very, very low, but the yield is high. In other words, there's high interest or yield on their loans, yeah? Right, governments, ideally for them, they want their loans or their interest rates to be as low as possible because then it's easier for them to pay it back, yeah? Now, in that world, there are these institutions called credit rating agencies. The only rating I need you guys to know is the top rating. The top rating is called AAA, which is written like this, 3 A's capitalized, yeah? AAA indicates to investors that you are the safest of the safe. If you have a AAA credit rating, realistically, if you basically issue bonds, the bondholders are told, listen, you're probably going to get your money back. Like realistically, that country will pay you back. And if you think about it, by the way, countries that have AAA credit ratings then, is the demand for their bonds likely to be high or low? Well, the demand for their bonds are likely to be high, the price is likely to be high, and the interest on the bonds are likely to be low. And that is amazing for those economies, yeah? So it's important to recognize that credit ratings determine how safe you are, and therefore the safer you are, the lower the interest you get, and that makes it easier for you to pay back your debt, yeah? Okay, right. Let's deal with a different topic altogether. A lot of you were asking about inequality, so let's deal with it. First things first. I think the best paper to deal with in terms of inequality is June 2012 of the old spec. So we're going to go through it together. So if I open old spec, unit 4, June 2012, I'll show you guys a handful of questions that we can answer together. Unit 4, June 2012. Okay. Okay. And the data response is all here. Yeah. It's a whole extract about inequality. Now, in the new spec, realistically, they're not going to have a whole extract just on one topic. That would be like unheard of. I'd be very surprised if they did that. In the old spec, they did. Yeah. And so I want to deal with a certain number of questions here that you could hopefully kind of use in a variety of different contexts. Starting with this one, the 8 marker. With reference to figure 1, explain how income inequality is measured. Illustrate your answer with a Lorenz curve diagram. So let's just quickly do some revision. Let's work out what the Lorenz curve shows and understand how to shift the Lorenz curve to illustrate either an increase or decrease in inequality, yeah? So I'm going to share my screen in terms of the board. And let's just draw the Lorenz curve over here together. Right, the Lorenz curve illustrates the level of inequality within an economy. And the two axes, often people forget which is which. I have a silly way for you to understand which axis is which, yeah? The first is we're going to look at obviously the cumulative share of income, so all of the incomes in the economy from 0% through to 100%, and then the cumulative share of households or the population, okay? Silly way of remembering it. This, what letter does that look like? Do you agree? It looks like an I. And income starts with which letter? I. This is therefore going to be the income axis. The other way of understanding or remembering this is the letter Y represents income in economics, like YED, income elasticity of demand, right? What axis is this? It's the Y-axis. That's how you remember it. Yeah, so you're going to have cumulative share of income, and that's expressed as a percentage. And over here is the cumulative share of population. Could also say household, same thing. And again, that is expressed as a percentage. Right. The very first thing to basically understand is that you need to draw a 45-degree line. So we're going to draw a line like this, yeah? And those of you that are mathematicians amongst us, that should, by the way, be originating from the from 0, 0. Mine's not as clear, but whatever, yeah? Right, what does that line represent? Well, mathematically, y equals x is the equation of that line, That line is the line of absolute equality. Wow, hallelujah. Yeah. Now, obviously, in reality, we are not going to be on that line. The further away your curve is from that line, then the more unequal your society is. Yeah. So let's say hypothetically that we're going to go, okay, so here is the level of inequality, let's say in the UK to begin with. And if suddenly inequality were to increase, well, you would shift it outwards. It goes further away from the 45-degree line. Make sure you point it with an arrow in that direction. Yeah, so that's basically income inequality worsening. Yeah, if it was getting better, the arrow obviously is pointing the other way. It would be shifting towards the 45-degree line. Yeah, is that clear? Right, first things first. I need you guys to understand what the Gini coefficient represents, and is an easy way of remembering it. The Gini coefficient is the measure of inequality that you guys need to be very familiar with. It's very easy. The Gini coefficient, so Gini is Gini, ranges from 0 to 1. Right, again, how do we remember this in a silly way? 1 looks like what letter? Well, 1 looks like the letter I. Therefore, that is I inequality. Wow, crazy stuff. So this is absolute inequality. Cool? Obviously, 0 then is absolute equality. Okay. Now, if we look at the figure for June 2012, I'll show you guys in a second. It illustrated that basically inequality rose basically all the countries. Yeah, it went up in China, it went up in the US, in Sweden, and the UK. It went up everywhere. Yeah. So the diagram that I would have wanted you to draw for that 8 marker was this, to basically show that inequality was worsening and the Gini coefficient was going up. Yeah, that is that. Simple as that. Easy, easy. That is easily like picking up the marks. Yeah. Okay. Right. Let's go and share screen again. And I want to deal with the 10 marker. This 10 marker, I have a YouTube video and I've actually done I think like a TikTok and social media, like Instagram video on this, but just in case you've not watched it. This question caused utter uproar that year. To what extent is income inequality an essential ingredient of capitalism? Okay, cool. Right. This is one of those questions, though, where there is a set answer. Well, I want you to write the same thing regardless of what they ask. And I'll show you one more awkward question they've asked about inequality. Again, just to show you that if you just apply logic, you'll be able to pick up the majority of the marks, yeah? Right, first things first. What is capitalism? That's really important to know. Well, a good kind of mental exercise to do is to go, what is the opposite of capitalism? Some of you hopefully will know the opposite of capitalism is communism. In a theme 1 perspective, what is communism? Theme 1, communism is a command economy. Yes? Well, then the opposite of a command economy is a free market economy. Capitalism has 2 key features that I need you guys to understand. The first key feature of capitalism is the private ownership of assets. Right? What does that mean? What it means is that individuals can own assets like a house. So number 1, private ownership of assets. Okay. Why is that important to understand? In communism or in a command economy, who owns all of the assets? Well, the government own all the assets. They own everything from like the buildings to like the businesses, etc., etc. But now in a capitalist economy, I can own my house. Do you guys agree that obviously those individuals that accumulate more assets would become richer compared to those with few assets? Obviously. And the thing is the reason why that's a really powerful point to understand is that the wealth that they generate from developing or basically purchasing assets will allow them to develop more income. In other words, the wealth inequality will lead to higher levels of income inequality. Can I just clarify why? Okay. Imagine if I own 10 houses. Do you guys agree that I'm not going to live in 10 houses? I'm going to live in 1 house. What do I do with the other 9 houses? Well, I obviously rent it out. So now suddenly I'm deriving rental income. Those individuals, on the other hand, that are renting, do you agree that they're struggling to save to buy the assets? Whereas I'm earning all this rental income. What do I do with it? I go buy an 11th house. And so again, what do you get? You get more wealth inequality, which feeds into more income inequality. In other words, is inequality an essential ingredient of capitalism? Well, yeah, because obviously, in other words, like, is it inevitable? Well, yeah, it's inevitable because realistically, you're going to get income inequality arising from people being able to own assets. That's our first analysis. Second analysis, 10 mark, I want 2 analyses and then 1 evaluation. Second analysis is to now talk about the second role or kind of ingredients of capitalism. The second feature of capitalism is the profit motive. What does that mean? Individuals have the incentive to take on the risk associated with setting up a business. Because if those ventures are successful, they will obviously get a lot of money from those businesses, yeah? Again, why is the profit motive lacking in a command economy? In communism, the government own everything. So even if I make like an amazing innovation where I work really hard, the government decide how much I get paid for it. It may not be worth it for me. In capitalism, on the other hand, if I take on the risk associated with entrepreneurship, I set up a successful company. And if that company now generates loads of profit, do you agree that obviously the person who set up the business is going to benefit way more than the people that they employ? Obviously. Is that clear? In other words, is it inevitable? Is it an essential ingredient? Yes. So a good example, by the way, is this, is that Amazon, when they make loads of profit, who benefits more, Jeff Bezos or Jeff, the delivery guy? Obviously Bezos, because he took on the risk in setting up the business. In other words, the profit motive means that inequality will happen. It's inevitable in a free market economy that you're going to get inequality. Those are the two analyses. Is that clear? Set in stone every single time. One, private ownership of assets. People can accumulate assets. They're going to be richer relative to those who have few assets. Number two, the profit motive. If businesses are successful, those who set up the business are going to benefit a lot more than the people they hire. That's our two analyses. Eval. Right, the evaluation, again, is kind of set in stone. So if I again go back to the data, is there such thing in real life as a pure capitalist economy? Pure capitalism means there's absolutely zero government intervention whatsoever. Is that the case in any country? No, no country is pure capitalist. In other words, would you agree that the UK, we'd argue, is a capitalist country? The USA is a capitalist country. Sweden is a capitalist country. Right, in other words, if I look at figure one, these are all capitalist economies. Even China, by the way, I know that like the ruling party is the Communist Party. They are basically capitalist. They trade, and all of that. Anyways, right? So if we ignore China, for example, US, India, Britain, Japan, Germany, blah, blah, blah. These are all mixed economies where they definitely are capitalist, but the level of inequality varies. Why does that matter? Because you can say the government can intervene to limit the extent of inequality. They could adopt progressive taxation. For example, if they have like high top rate tax, then that's going to help reduce income inequality in the country. If they have things like a national minimum wage, that can also reduce the level of income inequality within the country. In other words, the evaluation set in stone is, however, capitalist economies in real life do not exist. They are mixed economies. And therefore, the level of inequality can vary between capitalist economies. For example, the Gini coefficient in America, 0.38 maybe, whereas in Sweden, it's 0.23 maybe, yeah? This would indicate that in Sweden, there are a lot more progressive taxes than in America, and that helps to bring down the level of inequality. So that's super clear, yeah? One last question, I'll come back to this extract in a second. In June 2018, they decided to throw an absolute disgusting question at you guys. Yeah, I think I've opened it, haven't I? Yeah, I have. Right. This is June 2018, isn't it? Yeah, this one. There we go. 10 marker. Right. 10 marker says, assess the view that some level of inequality is desirable to maintain an appropriate incentive structure in the economy. Yuck. Okay, let's deal with it. Again, what I want you to do is not panic. Just be like, okay, cool. I'm just going to write as if I am the boss. I'm going to write and just, like, as long as it's logical, it's going to get some marks. I don't need to get all the marks to get an A star. I'm accumulating marks throughout the paper. That's how I get an A star. Okay, firstly, keyword. One of the keywords is incentive structure. Right, what does the word incentive mean in English? If you have an incentive, it's basically a reason to do something, yeah? Okay, so inequality or some level of inequality, why might that result in incentives? Let's work it out. If I again compare communism to capitalism, in a communist economy, imagine that every single person is paid the same salary. So if you stack shelves at a supermarket, you get paid the same amount as a neurosurgeon. Okay, are you going to bother to go to university, develop all of these skills to become a neurosurgeon if you get paid the same amount as a cashier? Realistically, no. Therefore, do you agree there's going to be a major shortage of skilled workers if you had that? Whereas in a capitalist economy, do you agree that obviously you see certain individuals and see certain professions like financial services, etc., and you go, whoa, these guys earn bucks, they're making so much money. And therefore, you have the incentive to upskill. You have the incentive to do well in your A-levels. You have the incentive to do well at university. You have the incentive to basically pursue higher skills in the pursuit of a higher pay. In other words, that inequality, that person, for example, who started off earning very little compared to someone who's earning a lot because they don't have the same level of skill as the person who's earning a lot, it gives them the incentive to go and actually pursue those skills, to go and train themselves, get educated, blah, blah, blah. Is that good or bad for the economy? That's excellent for the economy, because then you're going to have high-skilled labor, the productive capacity of the economy can shift outwards, the LRAS curve. That's the analysis. That's basically to say, hey, yeah, it is. It is a desirable thing because it will incentivize individuals to pursue those kind of like high skills. The other thing you could talk about, and bear in mind, it's a 10 marker, and it's the wording of the question doesn't need 2 points, yeah? But the second thing you could talk about, just to be safe, is that firms. Again, would I innovate if I'm a firm if it was a communist economy where the government own my business, all the profits I make, the government decide what to do with it? Well, no, but in a capitalist economy, why would I want to innovate? Why would I have the incentive to basically come up with amazing high quality products that are dynamically efficient? Because if I basically come up with the innovations like Apple do, I get so much money. And again, there is going to be inequality. Obviously, the firms that make technological breakthroughs, that produce quality products or quality live streams, come on, right? They are going to benefit more than the individuals that aren't high quality. Is that really clear? So therefore, is it desirable? Yes, it's desirable. Because what ends up happening is you get more innovation in the economy. Happy? That's it. That's the analysis. And I know that's not that deep theory, but what you need to understand is that for questions like this, just apply logic to the best of your ability, explain it to the best of your ability, and that's going to get you the analysis marks. Now, the evaluation here, again, it's not like a set in stone evaluation that you go, oh, it's that. But very briefly, the evaluation here is to basically say that excessive levels of inequality is never desirable. And there are two reasons why. In countries where there's really high levels of inequality, crime rates tend to be very high. If people are really, really struggling because they're so poor and there's like a small handful of really rich people, you're going to get a lot of like social unrest and loads of crime. That's obviously not desirable. The second thing that you have is that TNCs actually may be deterred from investing in countries where there's crazy levels of inequality, because if the vast majority of people in the country are really, really poor, they can't afford to buy their goods and services. Therefore, they go, no, thank you, because the market amongst the rich might be a very small market. And realistically, like if I'm, let's say, a cafe, like let's say I'm Costa, I don't have the incentive to set up in these countries where there's excessive levels of inequality. So you don't want there to be too much inequality in your economy. That is the evaluation. Happy? Beautiful? Yes? Cool. Let's go back to June 2012. June 2012 now, after we did the term marker, is this. With reference to the information provided and your own knowledge, assess the likely reasons for the change in inequality within countries. Okay. This is one of the only times in the Q&A where I actually want us to read the data together, because I want to see if you guys can spot something. So I'm going to read it out to you, and then I want to see if you guys are kind of locked in and are able to understand what I'm getting at. So we have the following. Extract 1. Changes in income inequality. Globally, the income gap between the rich and poor countries has been narrowing as some poorer countries are achieving faster rates of economic growth. However, the gap between the rich and the poor has increased within many emerging economies, notably India and China, as well as within many rich countries. This is true not only in the US, but also in countries with a reputation for being more focused on equality, such as Sweden. In China, increased inequality has been associated with the drive towards capitalism, helping to enrich the growing entrepreneurial class. The continued industrialization of regions bordering the sea has helped to increase incomes of urban workers. Consequently, relative poverty is increasing. Poverty is becoming increasingly difficult to address as the rural poor are now concentrated in remote regions with difficult natural conditions. However, at the same time, China's rapid economic development in the past 2 decades has generated the most rapid decline in absolute poverty ever witnessed. It has already achieved the goal of halving the number of people in extreme poverty by 2050, set by the UN as one of 8 Millennium Development Goals. In the US, income inequality began to widen in the 1980s, largely because the poor fell behind those in the middle income group. More recently, the shift has been overwhelmingly due to a rise in the share of income going to the very top, the highest 1% of earners and above, particularly those working in the financial sector. Analysis by The Economist suggests that the gap between poorer and richer regions of a country increased during the recession of 2008-2009 in some developed economies. In Britain, the income gap between richer and poorer regions is likely to widen further as government spending cuts fall disproportionately on less prosperous parts of the country. GDP per head in the poorest quarter of Britain's region is now lower than the richest region of China. Okay, right, let's go. Gonna drink some water, and you guys think about what the answer is to this. Why did I read that extract? I read that extract because I wanted to see how locked in you are and how you understand. And I bang on about this. I bang on about how there are clues in questions before and after the one you are doing in the data response. And if you recognize the clues, it may give you a point. You know the marker that we just did? Talking about how capitalism results in inequality? Okay. My first analysis is this. In China, increased inequality has been associated with the drive towards capitalism, helping to enrich the growing entrepreneurial class. That's the analysis. It's literally a copy-paste job for the analysis of the 10 marker you just did. One reason for higher levels of inequality is higher, like China moving towards capitalism. You now explain that these Chinese firms or individuals that set up businesses, they take on risk. If those risks are successful, obviously those individuals are going to benefit significantly more than the workers they employ. Is that going to lead to income inequality? Hell yeah, it's going to lead to income inequality. And therefore, I can reference the Gini coefficient in figure 1 and go, oh, wow, look, as they move towards capitalism, you go from a Gini coefficient of 0.28 in the mid-1980s to 0.4 in the mid-2000s. Boom. That's the analysis. Is that really clear? You, again, need to recognize that there are clues in questions before and after. June 2017, just to clarify, June 2017, 12 marker is about quantitative easing. Yeah? It was about whether the European Central Bank could raise inflation rates through quantitative easing. The 15 marker is about expansionary fiscal policy. They called it loose fiscal policy. That's a clue. Do you know why it's a clue? Because as part of the evaluation, you can say, hey, look, monetary policy by itself may not be successful because they may be at spare capacity. They need to basically adopt expansionary fiscal policy to support it. Otherwise, it ain't going to work. The 10 marker, June 2017, was about the appreciation of the euro. The 8 marker was causes of inflation. The appreciation of the euro, or sorry, disinflation, not the inflation. The euro appreciating makes it cheaper for you to import raw materials. SRAS shifts out, disinflation. Anyways, I'll deal with that later. The point I want you to recognize more than anything else, though, is I need you guys to understand there are clues. There are clues and questions throughout that you can pick up and you will be hopefully be able to spot them, yeah? Anyways, that's our first analysis. The evaluation to that is to say that although inequality has risen in China, they've actually lifted a lot of people out of absolute poverty. And actually, as you get more and more growth and their economy grows and grows and grows, the government might be able to now actually adopt progressive taxation, and therefore inequality might start to decrease in the long run. That would work pretty well, yeah? That's analysis number 1. I want to actually do 4 analyses, yeah? I know obviously you don't need 4, you need 2. I want to make sure that you guys fully understand this in full. Inequality, if it comes up, we're going to absolutely demolish it. So that's 1, is capitalism could be a reason for inequality rising. The other thing that we need to talk about is my favorite paper. My favorite paper, honestly, it's just so mean, is June 2022. I'm going to open it. I'm going to come back to 2012 in a sec. And also want to show you about how repetitive Edexcel are. How the questions are just the same thing in slightly different formats. June 2022 is the following. So, right, there's a data response, and it shows regional inequality in the UK. Right, now I'm going to quickly just summarize the data. But in a nutshell, the question, just to show you why it's so repetitive, is it talks about 2 likely causes of income inequality within the UK. Okay. Number 1, by the way, the go-to, and the one that we absolutely would do for this question, I'm going to do it in a second, is access to education. Yeah? The extract, and the reason why I find this extract hilarious, without the meaning to be hilarious, is it was speaking about how there was a much higher level of academic attainment in areas like London compared to Rotherham. Here we are. Look, in Rotherham, for example, 21% of disadvantaged 18-year-olds from state schools and colleges go on to higher education compared to 41% in London. Imagine you're sat in the exam and you're in Rotherham. Just, what are you thinking about your life? You're like, oh my God, they're trolling me. They're literally trolling me in the exam. Anyways, the point is that access to education is a big, big thing here, yeah? And if I go back to the extract we were dealing with in June 2012, you remember how it said that in America, the vast majority of the top earners work in the financial sector. How do you work in the financial sector? Realistically, for you to work in the financial sector, you basically need to go to university and you need to get like a pretty good qualification, like an economics degree, for example, yeah? Okay, tuition fees, are they high or low? Very high, both in America and also, especially America, but also in the UK. In the UK, for example, tuition fees went up from about £3,000 to about £9,000 per year. And actually about a year ago, they raised the cap to about £10,000. Okay, do you agree that that means that low-income households are going to struggle to be able to actually go to university because of the fact that it's really expensive for them to go to uni? Is that clear? So that would be like another analysis. Another cause of inequality is access to education. It's the rich who already have the means to go to university, develop the skills, get the high-paying jobs, and you get income inequality. Does that make sense? There's a really clever evaluation. There are 2. The first clever evaluation, by the way, is to talk about how the government could subsidize education, especially for like low-income households. They can give them things like bursaries. They could provide scholarships. They could provide like student loans at really low interest rates. So maybe actually people from low-income backgrounds might actually be able to get out of this and actually still go to university. The other one is very, very recent and very topical. The other thing you talk about specifically for the UK is the UK government very recently took away the VAT exemption for private schools. In other words, it's now more expensive for people to go to private school because realistically, their fees have gone up. And if their fees have gone up, do you agree that that helps to reduce income inequality? A, because of the fact that they now might have more money to be able to spend on the state sector. So in the state education, you might end up with higher quality teaching, better resources, better facilities, blah, 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 blah. And that helps to reduce income inequality, yeah? The other one, by the way, is access to technology and how there are more resources available like this that you could utilize in order for you to hopefully get better grades get you into better universities, and so on and so forth. In other words, actually inequality or education, whilst it's clearly still a big issue, it may not be as big an issue. And there are ways around it. There are ways to basically promote economic development by investing into education. Yeah? Right. I'm getting water because my voice is going. That's 2. I said I'll give you 4. I promised I'll give you 4. Let's go. Number 3. The third, again, June 2022 is really useful for this. In the June 2022 paper, where is it? Here it is. Yeah. The other issue, and it's literally written for us, secondly, is different levels of infrastructure spending. Different levels of infrastructure spending is a big issue because it talks about how, again, London gets the majority of the capital investment the government basically put money into towards. There are several issues with having really good capital in one place and not in another place. If I have really strong capital, like when I mean capital, by the way, I mean like, trains and transport links, etc. Well, do you agree 2 problems or 2 things? Labor is far more geographically mobile in London than it is outside of London. So there's regional inequality. But number 2, where are TNCs going to set up? If you're a TNC, would you set up would you invest your money and resources in where the infrastructure is good or where it's bad? Obviously where it's good. Hence, there's far more FDI in London than there is in, I'm really sorry, Rotherham. Yeah? Are there therefore more jobs in London? Yeah, there are more jobs in London. Is the pay for the jobs higher in London? Yeah, it's higher pay in London. Is that going to result in inequality? Yeah, it's going to result in inequality. Yeah. Evaluation to that is the government could basically rectify that through things like HS2. Finally, they started building it. Yeah. Does that make sense? So that's a good way of basically evaluating it and saying, hey, maybe this isn't as bad as it used to be. There's another thing that I think is quite clever, by the way. Another thing that's really clever here is to talk about how maybe infrastructure is not as big an issue as long as people have a decent internet connection. You know why? Because COVID changed the dynamics. It changed the dynamics. You can work from home. So you might be able to work for a company that's based in London or somewhere else in the world, even if you're in Rotherham. Come on, Rotherham. Yeah. And therefore you can start earning more money because you don't need to actually physically go to the office to take up some of these jobs. That's the point. Super clear, easy peasy. That's number 3. Last one, number 4. Last one is taken directly from the data. And it's over here. Where was it? It was Britain. There we go. Yeah. You guys see it? So it said this. It said that in 2008, 2009, after the financial crash, some real world knowledge for you guys to know about. After Labour lost power, so Gordon Brown was in power at the time, the Conservatives and Lib Dems come into power. It's David Cameron and in coalition with Nick Clegg. And they adopt a policy called austerity. Austerity is a really fancy way of saying that there are significant cuts to government spending and higher taxes. Well, let's kind of focus on the government cutting spending. When the government cuts spending, who is it likely to affect more, the rich or the poor? It's going to affect the poor a lot more. Do you know why? When the government cut, it'll be cutting in areas like state education. Private education is unaffected. So people who can afford to pay for private fees, their education is hopefully not affected for them. But state education, suddenly now you have a lot more people in a classroom with one teacher. Therefore, the level of kind of the education is deteriorating. Their resources and access to like technology might deteriorate. Again, that makes it harder for these people to get better grades, harder for them to get into better universities, etc. The government, when they cut spending, it'll be like in the NHS. Do you guys agree that NHS is more likely to be used by low-income households? High-income households can afford to get private healthcare. So again, austerity then is a big contributing factor to inequality. It's probably one of the biggest contributors to inequality in the last decade in the UK. That would be the 4th analysis. Obviously, you don't do 4 analyses. I'm just covering this in as much detail as possible so that you guys can easily answer anything about inequality. Yeah? Does that make sense? The very last thing is to evaluate that. Well, they're no longer doing austerity. You could bring in the fact that they're now adding VAT for private schools, and the government might start spending more in state education, etc., etc. Clear? One last question. One last question, and then we'll move on to this topic, is the 15 marker. And it's so easy. Evaluate policies which a government could employ to reduce inequality within its country. We have a set answer to this. It will always answer it. Number one, without a shadow of a doubt, is investment into education and training, always and forever. And again, we describe how if you invest into education training, you target specific regions. Rotherham will get you back. Yeah. You invest into education and training there. You make it more affordable for people to basically take up jobs. You can even, by the way, start incorporating some real world knowledge that you've accumulated from paper one from data response. June 2018, 50 market is about occupational and geographical immobility in the energy sector. There's a skill shortage in the energy sector. For those of you that have read that extract, there was a lack of females taking STEM subjects. Okay, let's basically subsidize education for females to basically take up STEM subjects, blah, 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 blah. So develop that in detail, talk about how that will basically allow low-income households to get better education, and therefore they can earn higher income. Inequality reduces. Easy peasy. Evaluation to that is a massive time lag. It's a massive time lag. It's going to take ages for you to fix this. This is not a quick fix in the slightest, yeah? So that's number one. Second analysis, the clue is what we just read about. The clue is June 2022. I want to show you how linked everything is. Look at the 50 market here, by the way. Benefits of an increase in infrastructure spending in the UK economy. One of the benefits, it can reduce income inequality. Because if they basically invest into better infrastructure, specifically in regions where there's a lack of infrastructure or poor infrastructure, labor becomes more mobile. TNCs are more likely to set up, more jobs get created, etc., etc., etc. Those individuals in those regions can therefore come and take up like better paid jobs. Inequality reduces. Evaluation to that. Do you think it's cheap? Clearly not. Fiscal deficit goes up. National debt goes up. Credit rating might go down. Downgrade results in the government basically struggling to finance future debts. Is that clear? Yeah, that is it. That is inequality in a nutshell. Hopefully that clarifies and makes it a lot easier for you guys to answer a range of questions on this. In truth, by the way, if this is a 25 marker, I'm not a massive fan. I only just, because it's so basic that I think fleshing out in enormous detail for a 25 marker is not the easiest thing to do. Yeah, it could still be the choice that you make. That's fine if the other question is a lot harder or you're not sure how to answer it. But bear in mind, in the vast majority of cases, I would argue the other choice is probably going to be the better choice. Yeah? Okay. Inequality, done. I want to deal with trading blocks and understanding what trading blocks are, understanding what kind of questions they could ask, and showing good data response from a past paper. Right. Let me share my board. Give me a second. I think it's disconnected. So yeah, it is. Okay, hold on. It's been inactive. Right. While I quickly just reconnect my board, I need you guys to understand a few things about trading blocks. A trading block is a group of countries that trade freely amongst one another. Yeah. So there are various examples of trading blocks. We've got things like free trade areas where they trade freely, but then they set their own external tariffs. Now, the two main trading blocks that I need you to understand is a single market, which is like the EU, and in particular, monetary union. A monetary union is the Eurozone, where they not only have free trade between each other, they also share a common currency. Okay, let me share my screen and let's deal with this as a question. Right. So if you get a question about the benefits of a trading block, a very easy thing to always talk about that will always work is a concept known as trade creation. What is trade creation? So the first thing that we describe is trade creation. Okay. Trade creation is, hence the name, where the volume of trade between the countries within the trading bloc increases. Why? Because one of the big benefits of free trade is that as an economy, you are better placed now to tap into your comparative advantage. Comparative advantage is basically where you have a lower opportunity cost in the production of a good or service compared to another country. Yeah. So if I now specialize in what I have a comparative advantage in and then trade with other countries in the bloc, that is amazing, because what ends up happening is that it results in higher living standards. It results in more resources. It could result in export-led growth. So exports component of AD will shift out, multiplier, all of that. Easy peasy. Yeah. So that's trade creation. The opposite, the evaluation that will always work, is something called trade diversion. Right. Let's talk about what trade diversion is. Right. Trade diversion is where trade gets diverted away from more efficient countries who are outside of the bloc towards less efficient countries within the bloc, right? What does that mean? The best example to understand this with is a very random one, but it's actually a true example. The UK, when they joined the EU in the 1970s, now I know obviously that we're not part of the EU anymore, I'm aware, yeah, but let's go back to the 1970s, yeah? Prior to the 1970s, the UK used to buy the majority of their butter, guess where from? or the UK used to buy the majority of its butter from New Zealand. Okay, let's just make up some numbers. Imagine that New Zealand's butter, including transportation costs and everything else, let's say is £2, yeah? Now, when we joined the EU, we diverted our trade away from New Zealand towards France, and I'm going to explain why. So here's French butter. Let's say that France, their butter costs £3. So right now, if there was free trade between us and New Zealand and us and France, I would just continue buying it off New Zealand because they're better at producing butter, yeah? But the thing is that France are part of the EU, so we have free trade, we continue to have free trade between them, but New Zealand are not. So we now place a common external tariff on their butter. Let's say hypothetically the common external tariff happens to be £1.50. How much does their butter now cost? Well, it now costs £3.50. Who are we now buying our butter from? Are we buying it from New Zealand or are we buying it from France? Well, clearly we're going to be buying it from France, yeah? And therefore, trade has been diverted away from the more efficient economy outside of the bloc, New Zealand, to the less efficient country within the bloc, France, simply because the common external tariff distorts comparative advantage for those who are outside of the bloc. Is that really clear? So that, I need you to understand, is a generic analysis and evaluation that always works for any trading bloc. Okay. I just want to show you guys one question before we delve with like the Eurozone and the good and bad things about joining the Eurozone. One of the worst questions they could ever give you was asked in June 2019, paper 2. Let's open it. So paper 2, yep, June 2019, question number 7. Let's look at it together. So June 2019, sorry. Paper 2, question number 7, looks like this. Here we go. It says, 3 of Africa's main trading blocs have agreed to form the Tripartite Free Trade Agreement, TFTA. This will create one of the world's largest free trade areas, stretching across 26 countries with a combined GDP of around £1 trillion. So you're reading there, you go, oh, that's not bad. Maybe they're going to ask me about trading blocks. That's nice. Then you read the question. And the question says, evaluate the effects of the growth of trading blocks, such as the TFTA, on global trading patterns. Uh-oh. Let's deal with it. Okay, let's understand what global trading patterns mean. Global trading patterns essentially means where is trade directed? In other words, if I go back to the 1980s or 1970s, China was not a big exporter in the world market. So therefore, the pattern of trade was not China to the rest of the world. It would have been like different countries nearby to one another. Like a lot of it is like, like your neighbors, yeah? China then suddenly getting really good at producing manufactured goods. Now the pattern of trade is that a lot of countries buy Chinese goods, right? So the pattern of trade would have changed. That's what they mean by pattern of trade. It's essentially the direction in which trade is moving, yeah? I want there to be a set answer to this. I want you to understand exactly how to answer this question. And the way we're going to deal with it is to go back to what we just described a second ago. First analysis is this. Your first analysis is to say that the growth of trading blocks is going to result in higher levels of trade diversion. That's going to be analysis number 1. Trade will be diverted away from countries outside of the bloc and be focused within the bloc. Even though those inside the bloc may not be as efficient, they look artificially cheaper because there's free trade between those countries, whereas there's a common external tariff for those outside the bloc. Cool? That, therefore, is the first analysis. You're going to explain that trade diversion, it changes the patterns of trade so that trade is diverted away from those who are outside of the bloc to those inside the bloc. I would actually give the example of New Zealand and butter, by the way. It's a real-world example. It works. To basically explain that prior to joining the EU, the UK used to buy the majority of its butter from New Zealand, but because they joined the EU, had free trade with France, but they had a common external tariff, suddenly the pattern of trade changed from basically getting it from New Zealand towards getting it predominantly from France. That's the first analysis. Let's evaluate. Can I tell you what the evaluation is? The evaluation is actually for certain countries and certain goods, the pattern of trade won't change even if you're in a trading bloc. There are certain goods that you cannot only realistically get from those countries. Example, Botswana are the biggest exporter of diamonds in the world because they have the biggest diamond mines, yeah? So even, by the way, in the context of things like protectionist policies right now, yeah? Do you guys agree that even though America have placed tariffs on basically everyone, yeah? Realistically, the pattern of trade when it comes to diamonds is not affected. Because if you want to buy diamonds, you're buying it from Botswana, because realistically, that is the biggest exporter of diamonds. Similarly, if you want to buy cocoa, realistically, the cocoa will come from the Ivory Coast or Ghana. The pattern of trade, therefore, may not go down. It may not it may not be affected. If a country continues to have a comparative advantage in the production of a particular good, because they have, let's say, the natural climate to grow that good, the pattern of trade is unaffected. affected. It may not result in trade diversion because realistically, you continue to buy it from that country. Is that clear? Second analysis. Second analysis is now trade creation. The pattern of trade is now shifted towards you trading a lot more within the bloc. You will be able to trade more easily. There's free trade. If I talk about, let's say, Croatia joining the Eurozone, well, the Eurozone, they have the same currency. That makes it even easier to trade. And as a result, trade creation, there's a higher volume of trade. It's more focused within the bloc. Their main trading partners, by the way, Croatia, are Italy and Germany. Do they share the same currency? Yes, they share the same currency. And if they share the same currency, it makes it far easier for Croatian firms to basically plan ahead, to trade with more confidence. As a result, trade creation, the pattern of trade is going to be focused within the bloc. You're going to have a lot more trade inside of the bloc. Eval. The evaluation to that is kind of like magnitude. And what I mean by that is this, is that it depends on the size of the bloc. The EU, for example, is made up of 27 countries. So yeah, okay, there's going to be a lot of trade focused there. If I compare that to another trading bloc, it's called ASEAN, so ASEAN, that is, I think, they're made up of 10 countries. Okay, that's not as many countries. So realistically, those countries, yes, they will trade between each other, but they will continue to be importing loads of goods and services from other parts of the world as well, and not just within the trading bloc. And that's how you answer that awful question. So hopefully that makes it a little bit clearer, yeah? Cool. Right, let's delve into monetary unions and the good and bad things about a monetary union. This, I think, is very overdue. They have not asked this in a very long time. In fact, the last time they really asked the question about a monetary union was in the specimen paper. So I want to show you guys the specimen paper. It is over here. Right. Okay. In the specimen paper, the 15 marker looks like this. It's annoying because they don't have it all on one page. You have to basically like get through. There we go. Discuss the likely costs and benefits of monetary union to the 5 members of the EAC. Okay. I want there to be an answer that you follow all the time and will get you all the marks for this. The good and bad things about being part of a monetary union. The first analysis is trade creation. And part of trade creation is the idea that if you share a common currency, you can now, as a business, plan ahead with so much more confidence because you never need to worry about unfavorable exchange rate movements negatively impacting your profit margins. Example, Croatia, prior to joining the Eurozone, their currency was called the kuna, like Hakuna Matata, yeah? So if I quickly just share my board again, just to like clarify this point. Imagine that you are a firm in Croatia and you are trading with a German firm, yeah? So you're basically exporting your goods and you're importing, let's say, German goods. If the kuna depreciates relative to the euro, what happens? Do you guys agree that everything that you're exporting is now significantly cheaper and everything that you're importing is now significantly more expensive, yeah? The issue with that is that it means that your profit margin is being squeezed. You are struggling. You might even go bust, right? Whereas if we have the same currency, can 1 euro ever be stronger or weaker than another euro? So I'm just charging my phone so that it doesn't die. Well, the answer is a definitive no, right? There's no way that 1 euro can be stronger or weaker than another euro. And therefore, is it going to be easier or harder for you to plan ahead? It's much easier for you to plan ahead. It's much easier for you to know with conviction that no matter what happens, 1 euro will equal 1 euro. And your main trading partners have a euro as well. Therefore, you can plan ahead with more conviction, investment can go up, and all of that. Yeah, is that clear? We'll do the evaluations in a second because evaluations are amazing for this. Second analysis. Another benefit of being part of the Eurozone or part of a monetary union is FDI. TNCs are more likely to set up because of the fact that it's easier for them to trade. There's free movement of labor, free movement of capital. They don't need to worry about the exchange rate. So therefore, they're going to be more TNCs setting up in your economy. A great example of that, by the way, is Ireland. Ireland have benefited enormously from huge amounts of FDI. Google, Pfizer, who else has gone there? Johnson & Johnson, did he then? Joking, right. So all these companies have gone and basically set up their headquarters in Dublin, mainly because the corporation taxes in Ireland are really low, by the way, but also because they're part of the Eurozone. The Ireland, by the way, if you don't know, have the euro, yeah? They therefore generate enormous amounts of export earnings. Anyways, your analysis could be about FDI, how investment's really good, and job creation, blah, 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 yeah? Let's evaluate. There is one go-to evaluation. The best evaluation that I always want you to recognize is the fact that when you join a monetary union, you sacrifice your monetary independence, ironically, yeah? There is one central bank in the Eurozone. There is one central bank, the European Central Bank, that has to set an interest rate for all of the member states. This is practically impossible. The reason why it's practically impossible is if we take the example of Germany versus Greece, yeah? Well, Germany at one point were experiencing an economic boom, whilst Greece were in a deep, deep recession. Okay, let's work it out. What kind of interest rate would Greece need? Well, in order to shift out AD to stimulate economic growth, do you guys agree that they would need a really low interest rate? Cool. At the same time, do you agree that for Germany, high levels of growth tend to be inflationary? Therefore, they would need high interest rates to try and reduce inflation. Can the ECB cater to both countries' needs? The answer is obviously no. They can't basically set an interest rate for Germany and set an interest rate for Greece. Yeah, this is a big, big problem. And that is a phenomenal evaluation, by the way. That is the biggest cost. You cannot cater to both countries' needs. Now, as a bonus analysis, by the way, this is actually not taken from me. From the, I think it was 2011 paper or 2012 paper, they had the equivalent of a 25 marker, it was 30 marker back in the old spec. It was about whether the UK should adopt the euro as their currency. Obviously, that ship has very much sailed. They're going to be asked. They're not asked that. However, in the examiner report, there was a kid that wrote one of the best answers I've ever read in my life. And in that answer, they talked about home ownership. And they were talking about how home ownership in Germany, I've changed the numbers for you, was roughly about 45% compared to about 75% in Greece. Why is that important? Why is it important to know the different levels of home ownership? The reason why is because do you agree that a lot of homeowners will have a mortgage? And therefore, when the ECB adjusts base rates, it impacts the Greek economy more than it impacts the German economy. In other words, AD doesn't shift equally between all the different economies in the Eurozone because you're going to have differing impacts in terms of interest rates increasing or decreasing per economy. That is utterly phenomenal, by the way. That kid, wow, can't believe they wrote that in an exam. That's so clever, yeah? But anyways, the key point to understand is that being part of a monetary union, you sacrifice monetary independence. Is that really clear? Eval, right. One of the things I need you guys to understand is to recognize the overlap that occurs between different topics. So when I say like trading blocks or, monetary union, what topic is that more broadly? The answer is this is part of globalization. Therefore, if you're stuck in the exam, what you need to understand is you go, okay, do I know anything bad about globalization? Because if I do, it will become an evaluation, it'll be a cost. One of the bad things about globalization is that countries become too interdependent. They basically become so interdependent upon one another that if one country mismanages its economic affairs, it's very likely to impact you, especially your main trading partners. So a great example, again, is in the Eurozone. There were several countries. They have been, there's an acronym, it's a very mean acronym. It's called the PIGS. So PIGS. Portugal, Ireland, Greece, Spain. At different points in time, all of these countries had to receive bailouts. They basically accumulated so much debt that other Eurozone countries, the IMF and the World Bank as well, basically stepped in to save them from collapsing, especially Greece. Yeah. It is estimated, by the way, that German taxpayers contributed approximately 56 billion euros towards the bailouts of Greece. 56 billion. Yeah. France, by the way, contributed approximately 42 billion. Yeah. In other words, the problem with being part of a monetary union is that you become really interdependent. And if your neighbors suddenly start to mismanage their economy, it's going to impact you as well. It's not just going to impact them. Is that clear? Hopefully that's like really easy to now answer that question. The other thing that you could talk about, by the way, is the loss of exchange rate flexibility. Because you're now part of the Eurozone or part of the monetary union that they give you, your currency can never be weaker relative to others. Therefore, you cannot be price competitive in terms of your economy. Yeah? All right, cool. Right, let's do another topic. We're nearing, I think, near the end. So that's hopefully quite a few different topics that you guys can get your head around. I just want to show you guys another very useful data response to work around. And it's June 2012, but the other data response, where is it? No. Yeah, here we go, this. Right, the other data response, question number 5, has an extract about the Eurozone. Yeah? And I want to just discuss a few things about this. In particular, so let's zoom out a little bit. It's this question. Examine policies which might improve the competitiveness of the goods and services produced by Greece, Italy, and Portugal. Right? If there's one thing that I want to get across in this stream, it is how repetitive macro is and how the same point can be used to answer so many questions. And I'm going to show you. If you guys get a question about competitiveness, I want you to always answer it in terms of supply side policies and nothing else.
which hopefully you guys are really familiar with. Education and training will be my go-to. After I explain, how education and training results in workers becoming more efficient. It results in a reduction in unit labor costs. Look at, by the way, the data. If you look at figure 4 over here, this figure 4 shows unit labor costs. Unit labor costs, you want them to be low. Unit labor cost is the cost of each worker relative to the output that the worker basically produces. Yeah. So you basically go, look, you want to reduce your unit labor cost to be closer to Germany so that you basically have a more price competitive economy. Yeah. Do you agree that also workers, if they are educated, are more innovative? You can come up with new technological breakthroughs. You can innovate and produce higher quality. Blah, 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 blah. Yeah. All of that results in a more efficient workforce, more productivity, higher human capital, productive efficiency rising. In a nutshell, you become more price and quality competitive. That therefore increases your competitiveness on a global basis. Yeah. Eval, significant time lag. It's going to take ages for people to actually get educated. Yeah. Second analysis, you got a choice. Now, the one I probably would do is that I would say that they could reduce corporation tax, because if they reduce corporation tax, firms in your economy now have more money left over. They can invest it into new technology. TNCs might also relocate and basically bring over their technology and innovations. And again, that increases your competitiveness. The evaluation to that is that it results in the fiscal deficit worsening, national debt, credit rating, all of that good stuff. Is that clear? Right. I want to prove that the questions are repetitive and that you can use the same stuff to answer a variety of different questions. Let's deal with June 2018. Sorry, it's open somewhere over here, but I can't remember which one it's. That's 2019. Anyways, I'll reopen it. June 2018 has this question that threw people off. And I just want to get you to recognize one thing, yeah? I want you guys to realize the importance of planning and not jumping into answers. Because the thing is, the chains of reasoning, I think, are easy to develop and quick to develop. However, it's understanding what the question is asking of you and making sure that you know how to answer the question that they're asking and not what you want the question to be, yeah? So, stock market. With reference to extract A, discuss two macroeconomic policies apart from protectionism that a government could use to reduce the negative effects of globalization. Let's deal with it. So first things first, let's just actually try to work it out even before we read the data. Now, obviously, the data is going to be very, very helpful. But if I think about the bad things about globalization, one of the bad things about globalization is that the world becomes too interconnected. If your main trading partners experience a downturn, that will impact you. That's bad. Another bad thing about globalization is the fact that if you think about industries like manufacturing in the UK, is that a sector that has thrived or has it been crushed? It has been crushed because TNCs and most of the manufacturing sector has been outsourced to places like China, Taiwan, Vietnam, that don't have things like minimum wage or their wages are a lot lower than the UK. Okay, that's obviously an issue, right? Do you agree? Because that means that those individuals that were working in the manufacturing sector, they're now structurally unemployed. Their skills are outdated. People, they're not in that industry anymore. That industry's gone somewhere else. How do I fix it? Education and training. You get it? Education and training, because if I invest into education and training, I can develop the skills they need to be able to basically now go and work in whatever industry we have, like loads of job vacancies in. It allows them to basically upskill, etc., etc., etc. Does that resolve the issue associated with globalization? Well, yeah, it does. That's the first analysis. Evaluation, massive time lag. Yeah. Second analysis, second problem. All right. Well, do you agree that one of the problems of globalization is that companies, businesses like in your economy, struggle like hell to basically compete with TNCs? They are incapable of competing with the TNCs on a cost basis, quality basis, etc. What could I do? Well, I could reduce corporation tax. Because if I reduce corporation tax, they have more profits left over. And then they can innovate. And if they innovate, they might actually become globally competitive. And now suddenly they're not going to be crushed by the TNCs. What's the evaluation to that? The evaluation to that is two things. One is there a guarantee they're actually going to invest the extra profits into R&D, into new technology? Well, the answer is no. And the second thing that you could evaluate with is when I reduce corporation tax, the TNCs can also benefit from that because they're also in my economy. They're going to also be like, oh, thank you very much. We have more profits left over. And they innovate and they get even further ahead from your domestic firms that can't compete with them. Do you understand? This is what I need you guys to best recognize is that ultimately, do you know what I just did? My 2 points for supply side policies, education and training, and reduction in corporation tax. It answered that question. It answered competitiveness. It answers interventionist strategies to promote economic development. If I got that as a 25 marker, these are my two go-to points. Number one, education training. Interventionist strategies, by the way, are also known as inward-looking strategies, yeah? So if I'm a developing economy and I want to grow my economy from within, first thing I do is I invest into education and training. By investing into education and training, I ensure my unit labor costs go down. I ensure human capital goes up. I ensure that my HDI ranking goes up. LRAS shifts out. Blah, blah, blah. There's loads of things that you can easily develop in terms of education and training. Evaluation, either fiscal deficit, national debt, credit rating, or it's a massive time lag. It works. Both of them work really, really well. Second analysis, in terms of interventionist strategies, invest into infrastructure. Because if you invest into infrastructure, it's going to attract TNCs. It's going to make labor more geographically mobile. It can help reduce income inequality. You could draw a nice, lovely Lorenz curve with it shifting inwards towards the 45-degree line. Happy days, right? You've got a million things that you could say now, right? We've done it already earlier in the stream. Eval, massively expensive, or time lag. So if you did time lag for the first analysis as evaluation, do now fiscal deficit, national debt, credit rating. Are you understanding? Yeah, that's interventionist strategies. What would I do if it was a free market or a market-orientated strategy to promote economic development? There are two. Number one, first one is promote FDI by reducing corporation tax. Why? Because if I reduce corporation tax, more TNCs set up, and TNCs setting up in my economy benefits in multiple different ways. The easiest is this chain of reasoning, is that investment is a component of AD. Therefore, AD is likely to shift outwards. Investment is also, though, an injection into the circular flow of income. And so there's likely to be a positive multiplier effect. In a developing economy, by the way, the multiplier is big. Why? Because the marginal propensity to consume is high. They spend most of their income. Therefore, the multiplier continues for a longer time. You can even explain it with an example. You could talk about how firms will hire more workers. Those workers now, with the income they generate, like the TNCs might hire more workers, they spend in the economy. Consumption, therefore, goes up. If people are spending in the economy, there's more demand for goods and services. If there's more demand for goods and services, labor is derived demand. Therefore, the demand for labor increases. You reduce, if you want to really show off, cyclical unemployment. Cyclical unemployment has another name. It's called demand deficient. Basically, a lack of demand leads to a lack of demand for labor. Well, here, there's more demand for goods and services. Therefore, there's more demand for labor. You shift out the AD curve twice like an absolute boss. And now you basically show economic growth going up. And you say that living standards go up. And you now say the HDI ranking for these economies goes up. That is an absolute banger of an analysis, yeah? Whether that's a 15 marker like in June 2023 or a 25 marker, easy. First analysis. Evaluation. Let's talk about bad things about TNCs. There are plenty of bad things about TNCs. One of the bad things about TNCs is that they can come and exploit the living life out of your workers, especially in countries where there's limited laws, like environmental laws or labor laws. And therefore, do you know what might happen? It might increase inequality because when you get more TNCs coming into your economy, yes, there are more jobs. Yes, people might be lifted out of absolute poverty, but there's also major exploitation of workers. And do you know what you can now draw? You can draw me a Lorenz curve. And a Lorenz curve shifting outwards, saying that their Gini coefficient goes up. Inequality is worsening. Wonderful. That's the first half of the essay if I got a market-orientated strategy essay. Second market-orientated strategy, I mean, you have a choice. The one I would probably do is trade liberalization. And actually, that leads us very nicely into protectionism and trade liberalization, and I'll kind of wrap it up from there. So let me just share my screen again. I also need water because my throat is absolutely killing me. So let's just take a little break. Right. Let's deal with it. I am actually going to do, by the way, protectionism first to make sure you guys understand the tariff diagram, and then I will reverse it to be able to do to be able to do trade liberalization. Yeah. Right. Let's deal with the tariff diagram and what a tariff is. You should all know that a tariff is a tax on imports. Yeah. So if we draw it like this. Okay. Since it's fairly topical, let us do it from the perspective of the USA. Let's say it was about the USA or the EU. Let's say the USA imposing a tariff. Yeah. So if I go, is supply. And this time I'm going to write SUSA to represent. This is the producers in the USA making this particular good. Let's just say this is electric cars. It's easy to understand it with an example, yeah? And this is the demand for electric cars in the USA at different prices, yeah? So here's D, USA. Okay, first thing to understand is that one of the assumptions in this diagram is that firms become price takers. We assume that everyone in the world has to sell this good at this fixed price, that you can get this good from anywhere in the world at this price. So let's say the world price, you can always do it below equilibrium, by the way, is this WP1 over here. And at that, we have the world supply over here. Okay, I actually really need to make sure you guys understand the concept. I need you to understand this diagram and not just memorize the diagram. Because if you try to memorize diagrams, you'll easily get it wrong. First things first. Do you guys agree? At this world price, I can always tell you how much is supplied and how much is demanded simply by going to the relevant supply or demand at that price. So at the world price of WP1, do you guys agree it hits the world or domestic supply, the USA supply over here? That's Q1. Is the supply of electric cars in the USA in my diagram high or low? The answer is low. And why? Why is it low? The reason why it's low is because do you guys agree that a supply curve tells me at different price points how many units you're willing to sell? Well, this particular world price is not a particularly attractive price. It's a pretty rubbish price for American producers. They go, I'll make some electric cars, but it ain't really worth my while making many electric cars. On the other hand, domestic demand is over here. Yeah? Domestic demand is significantly higher. Why is it high? Well, American consumers go, hey, you know what? It's really cheap. I want to buy loads of electric cars. Cool. Let's do numbers to just kind of understand this concept. Imagine this number was 10 and this number was 80. Do you guys agree that the amount of electric cars being made is 10, but the number of electric cars being demanded is 80? Well, there's a discrepancy now. There's a discrepancy between how much is demanded and how much is supplied. There's more demanded than supplied. Okay, if you're in America then, and only 10 electric cars are being made in America, but you want 80, how do you get the other 70? Well, do you agree that you buy it from abroad? Therefore, that distance, Q1 to Q2, is the initial level of imports. That's why it's imports, by the way. It's imports because the demand exceeds the supply by that amount. Now the government decides to impose a tax, a tariff. What does that do? Well, it raises the world price to here. And we get world supply plus tariff. And this is WP2. Same exercise again. Now, at this new world price, it hits the domestic supply or the US supply at Q3, sorry. Is it higher or lower? Well, do you guys agree that it's higher? Why is it higher? It's higher because it now is a more attractive price for the manufacturers in America to produce this good. It's a higher price. They go, you know what? It's worthwhile. I'll do more of it. Domestic demand, on the other hand, is over here, Q4. High or low? Well, it's gone down. Why has it gone down? Because it's more expensive. Consumers can't afford to buy as much. Therefore, imports now is this distance here, M2. Okay. Every single time that we basically do this, I want you to then draw the following. You go A, B, C, D. There are 3 players in every single economy. And the great thing about this diagram is that this diagram is amazing because you can use it for both analysis and for evaluations. Let's break it up into the 3 players. The first player is the consumer. And I need you to remind me of what consumer surplus is from theme 1. Consumer surplus is the difference between the maximum price a consumer is willing and able to pay for a good and the actual price they pay for the good. Okay, consumer, is that demand or supply? Well, clearly it's the demand curve. Let's do a 3-step exercise to work out what the consumer surplus is here. So the maximum price that consumers are willing to pay for this good, do you agree, is over there, where the demand curve hits the price axis, the y-axis. That's the upper limit of what consumers can afford to pay, yeah? What is the price they actually pay for it? Well, the actual price they pay for it initially is WP1. So this is my second dot over here, yeah? I go there to there, and then I go across until I hit the demand curve because that's how many units are being bought, whether it's domestically or from abroad. So consumer surplus is this massive triangle over here, yeah? Okay, now consumer surplus, the maximum price that consumers are willing and able to pay. Has it changed? Well, no, it's still here. I'm going to do it as a square. But what has changed is the world price is now WP2. It's here. And then if I go across from there until I hit the demand curve, it's there. Yeah? What happened to consumer surplus? Consumer surplus went down. Can you see it was the 3 dots? It's now the 3 squares. It's this triangle now. Consumer surplus went down by minus A, minus B, minus C, minus D. The consumer gets absolutely decimated here. The consumer is way worse off as a result of the tariff. Yeah? Right. So that's consumer. Then we've got the producer. Producer surplus is the difference between the minimum they're willing to sell and what they actually sell for. First things first. Producer surplus, the supplier is the producer. So the first thing we're going to go is here. That's the minimum price they're willing to sell it for. So there's a triangle. The price they actually sell it for to begin with is WP1. Bear in mind, that I have a video on this, so you can watch this back if you're not 100% and not clear how to deal with this. So make sure that you watch that as well. Anyway, so we've got the lowest price is this. The price they actually pay is WP1. And then the amount they supply is this. The triangles that connect to make a triangle is that. The lowest price they're willing to sell it for is still here. I'm going to circle it. But the price they now sell it for as a result of the tariff is here. And I go across. That's how much they sell. Producer surplus, therefore, goes up by plus A. Okay. The very final player is the government. The government collect government tax revenue. How much revenue they make? Well, the government make area C. Can I show you why? The reason why is because the government make the level of imports coming into the economy, M2, is that distance from there to there, Q3 to Q4. That's how much they tax, the number of units they tax, and the tax rate is that height. That's the tariff. Okay, that is the there's summation. Now, if I was doing this, then what I'm basically going to do is just explain how this is really bad for consumers, because consumers are way worse off. That would be the evaluation. As analysis, it's good for the producers because producers now face less competition. Consumers will be switching away from foreign goods and buying more domestic goods. Producers in my economy therefore start generating more profit. Producers in my economy can now benefit from increased revenue, increased profits, increased dynamic efficiency, etc., etc., etc. Yeah. Okay. Right. So I'm really getting tired. I will wrap this up very soon. Just before it, I want to show you guys a question that is topical enough that it could potentially come up. So let's deal with it. And it is in the locked specimen paper, which I suspect many of you have not seen. I want to show you. The locked specimen paper looks like this. So let's just open it together. Let's full screen it. Let's do single page and zoom in. Okay. In the locked specimen paper, they have a really interesting 15 marker. Bear in mind, obviously, I know that Trump has come along and tariffs are like a big thing, but tariffs were being discussed a year ago because the EU were threatening to tariff companies like BYD with a 100% tariff. They were accusing the Chinese state of subsidizing BYD and other car companies like that, or other companies in China. And as a result, there was already talk of tariffs. So it would not surprise me, again, I promise it's not a prediction, whether it's in paper 2 or paper 3, that something along the lines of tariffs could come up, whether it's a 15 marker, 25 marker, I don't know, who knows, yeah? Anyways, let's look at the 15 marker. 15 marker says the following. Discuss the likely economic effects of the European Commission applying high tariffs on Chinese mobile equipment entering the EU. This is so topical, and I wanted to make sure that we do this near the end so that hopefully you retain this, yeah? I will give you context very quickly, yeah? The quick context for you to understand is that the EU are accusing the Chinese government of heavily subsidizing, there we go, like illegal government subsidies, to the Chinese telecommunications sector that give it an unfair advantage in global markets, right? Let's understand why. If the Chinese government provides subsidies to their firms, do you guys agree that that reduces their cost of production? This therefore means the prices that the Chinese firms charge for this product is low. They are therefore price competitive. Does that make sense? So that's the first thing, yeah? So that means that they become way more price competitive compared to European firms. So they're now retaliating to this by imposing their own protectionist measures. Analysis, number one. Now, very careful to understand the wording. Economic effects is broad. It doesn't specify whether it's the effects on the EU, on China, on consumers, producers, anyone. Economic effects is so broad, and that's useful. The reason why that's useful is because we're going to now break it up into 2 parts. We're going to deal with it from the EU perspective, and then we're going to deal with it from the Chinese perspective. Let's start with the EU. Our analysis is going to be this. One likely economic effect of the EU imposing heavy tariffs on Chinese equipment is that it may reduce unemployment in the EU. Let's understand why. And I'll give context. I go, according to Extract C, the EU accused China of heavily subsidizing the firms in the telecommunications sector. This sort of made Chinese firms more price competitive compared to European firms. By imposing a heavy tax, basically a heavy tariff, this levels the playing field because it increases the cost of production for the Chinese firms. Therefore, consumers may start now switching away from the Chinese products towards the EU products. And as a result, you end up with more revenue, more profits for the European firms. And because there's more demand for European goods, labor is derived demand. And as a result, there's more demand, more demand for labor. And therefore, unemployment goes down, specifically cyclical, by the way. Yeah? Now, you could be really clever. The reason why you really could be clever here, the tariff diagram is great. The reason why tariff diagram is great is because it can be used as both analysis and evaluation. I would therefore sandwich it between my analysis and evaluation so that I can allude to it both in the analysis and in the eval. What I'm going to say to wrap up the analysis is that producer surplus goes up by area A. Producers are better off. European producers are selling more. Their sales are going up from Q1 to Q3. The price they're getting is going up from WP1 to WP2. And they're basically generating more revenue and more profits. That's the analysis. Easy? So my voice is properly going. My throat is killing me. I will need to wrap this up very soon. I'll try and do as much as I can. But anyways, that's the first analysis. Let's evaluate. The evaluation is drawn tariff diagram. And the tariff diagram illustrates that it's really bad for European consumers. European consumers are way worse off. They have less choice. They face higher prices. The quality of the goods they get may be lower, etc., etc., etc. That's the evaluation to show that consumer surplus goes down, by A, B, C, and D. It is bad, really bad for consumers. That's the second half. Clear? Let's deal with the second half of the essay in terms of analysis. Now we deal with it from the perspective of China. Do you guys agree that if China face heavy tariffs, their export earnings are going to go down? Chinese firms are going to struggle to sell into the EU as much as they were before. If export earnings go down, their current account surplus, what will happen to it? It will shrink. If their current account surplus shrinks, X minus M is a component of AD. AD might shift inwards. Economic growth might go down. You draw it. That's just analysis. Easy peasy. That's the analysis, right? Eval. The evaluation to that is 2 or 3 things. The first thing that you could talk about, it depends on the PED for the products within the EU. If the PED is inelastic, then even with the tariffs, European consumers realistically will continue buying Chinese products. Therefore, it may not have much of an impact on the Chinese economy. 1. 2, the second thing you could talk about is it depends on how much of their sales were going to the EU. What if the Chinese firms were predominantly selling to, I don't know, Japan or the USA or whoever? Then maybe it's not that big a deal that they impose a tariff on them. That's the other thing. You know, the other thing that could happen is, okay, they might basically impose a big tariff on the Chinese products. You know what the Chinese government might do? They might double down and give them even more subsidies, in which case they continue to be price competitive, they continue to sell loads, and that is also a valid evaluation. Are we super duper 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 clear? Yeah? That is how you deal with a 15 marker like this if it were to come up. Right. Trying to think of the things that I've written on my list of things that I wanted to cover. I mean, I've covered hopefully a lot of things in this Q&A, and hopefully you guys feel a lot more confident. Can I just show you one last thing before I let you go? And it's a 5 marker in this paper. With reference to figure 1, calculate the annual CPI rate of inflation for China in October 2014, because it just requires you to understand index numbers and the relevance of index numbers and why it matters. Here is figure 1. Figure 1 shows the change in the price of food. It's gone up by 2.5%. Non-food has gone up by 1.2%. But if you know from things like CPI in the UK, we basically attach weightings to each item. And the reason why we attach weightings is because the weighting reflects the proportion of income spent on that good, and therefore how much of our inflation that particular thing should account for, right? Let's make it really simple to just understand this first, yeah? Imagine hypothetically, if in this figure over here, imagine that the only thing in the basket was food. So the weighting for food, let's say, was 100%. And then you were told that the price of food has gone up by 2.5%. What's inflation? It's just 2.5%, right? Does that make sense? Because inflation is the change in the price level. If the entire basket was food, then whatever happens to food prices is inflation. The whole point then is that you're now understanding that, okay, the weighting, therefore, I need to ensure that whatever my figure is, whatever the percentage change in the price of that thing is, it only accounts for a certain amount of the weighting, right? How do we therefore answer this question? It's through a very basic mathematical equation. You guys can do this by yourself. let me see if I can answer it. Right. This is how you do the maths. To work out CPI inflation, hold on, let me just annotate. We do the following. So we go, okay, I know that food prices have gone up by 2.5%. Okay, so 2.5, we'll do percentage at the end, yeah? And I need to multiply that by 31.8%. I need to ensure that of my inflation, whatever my inflation figure ends up being, the 2.5% change in the price in food should only account for 31.8% of my overall new inflation number. So what do? I multiply it by 0.318, and I've closed the bracket. I then add the other component, which is non-food. Well, non-food went up by 1.2%. 1.2 times, and that needs to account for 68.2% of the actual weighting. So what do? 0.682. Yeah, let me just move this a little bit over here. Can you guys see that? Yeah? And that, by the way, if you plug it into your calculator, you get something like 1.6. In other words, the answer, by the way, 5 marks, yeah? I know that may be something that you've not done before, but hopefully now that we've done it, if this comes up, this is easy 5 marks, yeah? The inflation rate in China was 1.6%. Do you know why? And that makes sense. And the reason why it makes sense is because of the fact that if non-food accounts for a larger weighting, the inflation rate should be closer to the change in the price of non-food, 1.2, than it is to the change in the price of food of 2.5%. In other words, the inflation rate of 1.6% makes complete sense because it takes into account the relative weightings of each of these basket items so that we're closer to non-food, the price change of non-food compared to food. Yeah? Hopefully that is really, really, really clear. Right. I tried. I'm so sorry. I know that you guys had plenty of questions and plenty of topics that I probably haven't gone through. But I honestly, like, I am absolutely worn out. I'm so tired. I was ill before this, and I wasn't going to postpone it because you guys have an exam in a couple of days. But I hope this was helpful. Thank you very much for turning up and for being part of this. Those of you that are watching this back later, what I recommend over the next 2 days, by the way, is past papers. Do as many data response questions, 25 markers. The old spec is relevant, by the way. Don't let anyone tell you otherwise, especially for Unit 4. Look at the data response more than anything else. Everything else, don't really, it's not that relevant to you guys. The data response, though, is incredibly helpful, yeah? I need you guys to basically work your way through as many past paper questions as possible. Just to clarify why past papers are king and why last year, not naming names, certain people came on the stream and were basically trying to dismiss the old spec and why it's not relevant. I want you to understand these people don't understand anything. Last year's paper, the 10 marker, was why a fiscal deficit is a cause for concern. June 2016, question 5E, old spec, unit 4. 12 marker was quantitative easing in the UK. New spec, June 2017, paper 2, question 6D. The 15 marker was supply side policies. I mean, there's a billion questions about supply side policies, but if you want one from the old spec, June 2015, question 40, supply side policies. Knock yourself out. 25 marker last year was ways to correct the trade deficit, specifically like in Brazil. Yeah, that has been asked multiple times, by the way, in the old spec as well as like a new spec. Anyways, please do as many past papers as you possibly can. Those of you that are coming to my course in person tomorrow, we will delve into this in a lot more detail, and I'll also do loads more like Section A questions with you guys as well. Anyways, we'll deal with that tomorrow. Guys, good luck. Go smash it. I'll see you guys for the paper 3 session in a couple of, like, about a week or so. I hope you guys do incredible.